Greetings, traders. It is I, Abdul Shabazz. This is Some Real Change Stock Options Trading Journey. And today, Monday, August the 24th, let's see what the market has in store. Okay. Okay. I like that. 672. That's where I want my alarm at. Below 672. What are we looking like for the day? Top right daily, bottom right weekly. Bottom middle is a 30-minute chart. We'll go with that view. Let's go with that view for a 30-minute chart. Go with this view for the 15. Okay. 58. Okay. Bottom left 15-minute chart, top left 2-minute chart, Heikin Ashi. Catching a flow with the market. I'm also looking at a call. 767, put a line there. Everything in between, I'm leaving alone. Allow the market to build up liquidity for the week. For the week ahead. Okay. Boom, boom, boom. A second here. She already hit that sweet area. She hit last week's low and swept right there. That was a really nice call. Okay. 11 o'clock hour is upon us. daily, the weekly. Okay. See what we're looking like over here. 767. Like calls is 767. I like puts below 762. Put alarm at 762.3. Call alarm at 767. Everything else in the middle, I'm leaving alone. Friday, Thursday, Friday's high. Friday's high. Okay. Referring to the higher time frames. Let's go ahead and cut on MSNBC, see what they're talking about. Turn it over to them.
Models themselves that runs on them. The Grok chip going live today is the hardware half of that same bet. The speed layer for the open models, NVIDIA now wants to build itself. For all of that, though, look at the share price, down about 2.5%. Stock just can't catch a bid. It's fallen, what, for the 7 straight days, its longest losing streak since September 2022, down almost 7% over that stretch. As Mizuho's Jordan Klein put it in a note this morning, buyers are in just no rush ahead of Wednesday night's results. Why try to be a hero ahead of that print?
Well, speaking of it, I mean, you're going to be talking a lot more about it between now and then, Christina, I have a feeling. But do we have any key expectations there in terms of what we'll all be looking at with NVIDIA, assuming, as usual, they report a very strong number?
Which is, see, you use the word assuming, right? The market already expects NVIDIA to provide these strong numbers. The market already expects the CEO to be extremely bullish, saying that, everybody is spending more CapEx, et cetera. So I think their focus is now more on gross margins being maintained at 75%, which we spoke about just in the last hour. And also why you saw price hikes, reports this weekend saying they're going to increase prices for their systems anywhere between 15 and 17%. And of course, the circular financing narrative that came up with that $500 billion initiative with those 6 financiers. I think the narrative that Jensen Huang and management will have to be on the call is just, it's not about circular financing. This is us deploying our money in smart ways. We have a lot of money in terms of free cash flow, and that is why we are very aggressive right now and acting almost like a VC, investing in these suppliers, getting equity in this company, also to make sure that we are a viable company 10, 15, 30 years out. This isn't just a 12-month game for NVIDIA.
Yeah, a big week there, Christina. Hope you get some rest between now and Wednesday. Christina Partsinevelos.
Yeah.
For more on this market, let's bring in Lazard Asset Management CIO Eric Van Nostrand. Eric also served as Assistant Treasury Secretary for Economic Policy under the Biden administration. It's really good to see you.
Good to be with you guys.
Maybe we start there. I'd love to get your take on everything that we've seen so far with regard to Treasury and its decision last week to do some buybacks and some of the reporting this morning about using, even more firepower to get yields down.
Certainly some unconventional policy out of the Treasury last week, but I think the market gave its feedback on that policy very quickly. The Treasury's had a stated goal of keeping long-term rates down since the start of the Trump administration. Clearly hasn't been very successful in terms of feedback. The market's been pushing yields up on concerns about fiscal sustainability over the past year and a half. We saw a quick reaction in Treasury's favor where 30 yields came down 24 hours later, they were back up at the same level. And I think the key lesson is that the Treasury by itself, the fiscal authority, doesn't have the firepower necessary to really twist the yield curve in the way that the Fed's historically been able to do. And I think Secretary Bessett's going to have to reckon with that.
What about the bond market specifically? Would you be a buyer of bonds? PIMCO's saying yes. You've got Ray Dalio on the other hand saying no, that there's a debt crisis around the corner. I mean, he's been saying this for years now, but.
At Lazard, we have been and remain very structurally worried about the long-term drivers of long-term interest rates, principally fiscal sustainability, where we think the policymaking community doesn't have a good solution in the near term, and markets are gradually starting to apply pressure to bring that about. So we're still underweight long in bonds, which means we still expect further increases in long-term yields. Now, that's not to say there won't be some short-term tactical rebound given all the yield increases we've seen over the past couple months, but structurally, we think this has room to run as the global interest rate market normalizes.
All right. Well, we see at the top here of some of your notes, you're constructive on non-U.S. equities. Why?
Well, it's something that's very different for me, David. My whole life, I've been kind of a U.S. exceptionalist, and with humility, people who've taken that view over most of the past 20 years have been mostly correct. But this is the first year where I'm feeling much more optimistic about the European market, the Japanese market in particular, relative to the U.S. Principally because I think those economies, while historically have been less pro-growth, less productivity enhancing than the United States, are on the margins moving more in that direction.
What would give you, when it comes to Europe, what would give you any sense that that really is the case?
I think what I'm not calling for is a pivot of Europe towards a super pro-productivity position. I think the key point is one Christina made a minute ago, which is that it's about expectations. And there's an enormous amount of negativity baked into sentiment from a couple years ago, saying Europe need to move in that direction. So I think on the margins, you're going to see a little more out of Europe. You're particularly going to see a little more out of Japan, where I think the recognition for growth demand is on the rise.
You do well. Japan at this point, though, I mean, obviously we stepped in to try to help them in terms of support the yen. Yeah. They are potentially facing higher rates.
Yep.
What about that picture gives you confidence to think that actually growth will be higher than perhaps anticipated?
Yeah, so I think one of the reasons they're able to put higher rates on, they're able to tighten monetary policy at the same time that they're focused on their currency, getting this international support, is that organic demand in Japan, households consuming, businesses investing, there's much more reason for optimism. That's consuming, businesses investing. There's much more reason for optimism there we're seeing in the data than from the policy side. So it's a very healthy optimism about Japan, and that I'm not saying the central bank's going to make it better, the fiscal authorities are going to spend. Japanese consumers and businesses are, I think, as well positioned as they've been to lead that economy upward.
What about emerging markets? That's essentially become a levered bet on AI just because of the three main chip makers in Asia, essentially. So is that a place where you would want to kind of balance what you're seeing in Europe, what you're seeing in Japan, or do you think that's essentially kind of similar to what we've got here in the U.S.?
Yeah, you hit the nail on the head, Leslie, in that if you're invested passively in emerging markets, if you're just holding the emerging market index, all the great performance you've seen and all the risk you're taking today is about the three semiconductor companies in North Asia that take up a third of the emerging markets index right now. That makes the case for what we do at Lazard for active management in emerging markets, where we're spending our time looking at a differentiated and deep manner at individual names. That's where the return in EM is, and we're very bullish those efforts to identify the winners and losers at the name level.
Yeah, the quest for to combat concentration risk is challenging. The quest to diversify. Do you think that the market is still overly optimistic about the geopolitical environment as we talk about, the concentration risk and the need to diversify outside of the U.S.? How does geopolitics play a role there?
Yeah, well, I think year to date, short answer is yes, by the way. I do think it's still optimistic because I think the AI optimism of most of the year hasn't felt like that the past 5 trading sessions or so. But the AI optimism of most of the year has masked the severity, in my view, of a lot of the geopolitical challenges coming out of the Middle East, coming out of our relationship with China, and of course, coming out of the global supply picture for energy, which remains in as weak a position, I think, as it's been all year. Markets are just trading more on the ups and downs of AI sentiment and looking through the still very real dynamic of what this global oil squeeze is going to mean for American consumers. And I do think that's going to weigh on sentiment this year.
And when it comes to all that CapEx being spent by so many companies, not just the hyperscalers, but certainly led by them, are you in the camp that says I'll wait to see whether, in fact, they get a return on all that invested capital?
Well, I think the key point is, again, expectations. The market's already betting there's going to be a massive realization there. So I can tell you all I want how bullish I am about the technology, and I am bullish about the technology, but I think it's discounted in the market already. So I do think the scope for disappointment from here is larger than normal. And that's why at Lazard, we're positioned a little more defensively than normal around those AI names.
You are?
Yes.
Meaning what, you don't own them?
We own them at a lower weight than we otherwise would. We're, active managers helping our clients take risk around a benchmark. So we very rarely are going to zero out in names that are very important to the concentration, but we're more defensive on them than we've historically been.
Interesting. Eric, thank you.
Thank
Appreciate
you.
it.
Good to be with you guys.
Good to see you.
Coming up, the Dean of Valuation, Aswath Damodaran, is going to join us, give us his new framework for understanding AI companies and why he says they've entered their bar mitzvah moment.
Mazel tov. President Trump's plan to ease beef tariffs drawing backlash from farmers and lawmakers. We're joined by the CEO of the National Cattlemen's Beef Association. Hear why he thinks the White House plan won't achieve its stated goals of increasing the U.S. beef herd. Squawk on the Street will be right back. Welcome back. OpenAI's Sam Altman making some new comments over the weekend. Kate Rooney joins us with more. Hey, Kate.
Hey, Leslie. So OpenAI CEO saying that the AI revolution may take a little bit longer than expected. Sam Altman appeared on David Senra's podcast over the weekend. He said we're still at the Palm Pilot stage of adoption.
A lot of the technology was there. Like, it was missing multi-touch, but mostly it was missing like the product ideas that made the iPhone. And I feel like we are now in a world where we have all of the technological pieces, but we have not had the iPhone moment of like completely changing how someone interfaces with technology.
Altman went on to say that AI adoption has been slower than expected, and so has the economic disruption.
The economy just has so much inertia. People keep doing the same things they're doing. They keep buying from the same company. They keep sort of wanting to use their tools in the same way. I think it's actually a positive in many ways, and it's going to make this big transition in front of us go smoother and slower, and I'm grateful for it. But I think it means we've all been too ambitious on timelines, even with this incredible technology.
A couple of other headlines, guys. Altman said that compute right now is the biggest bottleneck. He said that is where he's spending the most time at OpenAI. Two of the biggest risks for AI that he outlined, he talked about a loss of control where AI gets too powerful, and then one company or one model ends up having too much power as well. He also said OpenAI wants to be a platform company and not actually compete with its customers. So maybe a sigh of relief there from some software names.
Well, Kate, what does that mean to be a platform company?
So basically, David, that they would be, it's called an API, but they would be behind the scenes powering other startups. The fear around OpenAI, Anthropic, and others is that they want to go what people call up the stack. They want to be the actual app in the interface with customers and say disrupt, a traditional software company, Altman, positioning OpenAI as, hey, we're going to work with everybody on the back end and sort of white label our technology. We don't necessarily want to build, every legal company, every software company, every cyber company, which is where a lot of the software sell-up and the SaaS apocalypse earlier this year that we talked about came from. Altman, though, strategically positioning that, he also wants to win over enterprises. So if you think about the reasoning behind saying that and messaging that is that, hey, you also need to make sure that enterprises feel comfortable working with you. So clearly some motivation there to frame it that way. But he also talked about, ditching some strategic projects and some important projects. He talked about the power loss, or when you think about the venture capital mindset of sticking with the biggest, or one of the biggest bets paying off. He said, we ditched Sora, for example, because it was taking up too much compute. That was the video generation side of it. So got a little bit of his thinking behind OpenAI, but he still very much thinks like an investor in a lot of ways. Yeah, it's interesting hearing him talk about the centralization of power, though, but yet, wouldn't open source be one of the answers to that as well? It's interesting, David. That would be the obvious answer to that would be cheaper options out of China, and he's sort of danced around that. They didn't talk about open source in particular, but he did take some sort of veiled attacks at Anthropic. He talked about this caricature of AI power being in the hands of. I think he said he sort of described it as this fiefdom. Said. I think he used the word bequeath, but we're going to bequeath the AI on our. He didn't use the word peasants, but you know what I mean. He used this sort of analogy, this Renaissance analogy of AI companies controlling a lot of the power, doing amazing things like curing diseases, but at the same time, meaning that the average person gets a lot less control, and sort of use this maybe overstatement, a caricature of AI. He didn't mention Anthropic specifically, but a lot of people are picking up on that, saying, he's probably taking a dig at his biggest competitor there. Yeah, there's no shortage of digs at Dario and Anthropic, are there? Very subtle. Exactly. Yeah. Well, it's interesting. The two biggest companies, when they talk about a competitor, it's usually Anthropic. Yeah, it is. Kate, thank you. Kate Burney. Thanks, David. Let's stick with AI. It may only be less than 4 years, a little less, since ChatGPT was released to the public. But our next guest is saying AI could be having its bar mitzvah moment as the narrative around the technology shifts from, quote, hype and hope and straight into real business questions. Joining us now is NYU Stern School of Business Professor of Finance, Aswath Damodaran. Good to have you. I had one of those bar mitzvahs. I didn't know anything more the day after than I did the day before. I think she may have had one too. I don't know about you, Aswath, but I'm curious as to what you mean. We've been having fun with your quote all morning. Explain.
Every revolutionary change goes through 4 phases. The first, of course, is the hope and the hype. You're selling the idea, you're sometimes overselling it, and then you invest in the architecture to deliver that idea. And then comes the moment where you ask, is all this investment going to pay off? That's the bar mitzvah moment. We ask, are you grown up? Are you a real business? Are you just hope and hype? And I have a feeling that AI is getting there. It's gotten there faster than previous. It's happening in compressed time. If you take the railroads, this took 50 years. In the case of AI, it's happening in 4 years. And it's going to be the moment where you're going to separate the wheat from the chaff, the winners from the losers. And I think it's going to be telling. And I think Sam Altman's comment on inertia is interesting because who couldn't have seen that coming? Of course there's inertia. And he's missed two other things. One is the system will try to protect the people they're going to try to displace. And the second is the backlash is coming. You can see it coming. It's already happening. So I think that's the reality check that's coming. Doesn't mean AI is not going to be a great business, but there are the big moments are coming now where it's going to be tested.
Yeah, well, another big moment is probably coming fairly soon, and that will be Anthropic coming public. And, I'm curious, when you get a look at that S1, and we all start really trying to understand what the earnings power of this business is over time, how are you going to be viewing it, particularly given what you just shared?
I'll tell you what I'm not going to be looking at too much. It's an annualized revenue run rate, which I think is very self-serving for a growth company. I mean, it takes the last month, the last week, the last day, and just extrapolates from there. I think that's the least useful number here, because ultimately, to justify the $2 trillion or whatever they're throwing around as a number, what you're producing as revenues right now is not going to get you there. I need a story about why you think the total market is in the trillions of dollars, not in the hundreds of billions, because that's what you need to justify a $2 trillion pricing.
Which is what worked with SpaceX. You note in your latest blog that the upper ceiling for AI TAM, total addressable market, rests on total human compensation, which was $13 trillion in 2025. And of course, that capture relies on extreme labor replacement, kind of the outer edge of what we could expect there. Most don't think that ultimately happens. But I'm curious if you think there's additional TAM to be generated from IT spend as well, that it's not just a replacement of labor, but potential replacement of IT budget.
It could be, but I'll tell you why the best case scenarios for AI are nightmare scenarios for the rest of us. I mean, let's take the limiting case. Let's assume that AI products replace 80% of white-collar labor. That's great for AI companies, but what happens to all those people who lose their jobs, lose their income? So internally, there's a contradiction between what AI is selling us as best-case scenario and what the rest of the world can take as a hit from that best-case scenario unfolding. So that's the other thing I'm looking for here is there any reality check here where your best case stories are being checked against what happens to the rest of us? Where do we go for that income, those jobs we're going to be losing if AI kind of unfolds the way it's supposed to?
You know, during the period you referenced in terms of the building of the railroads, I mean, there was no shortage of speculation around that time. As a percent of GDP, I think the numbers were incredible, by the way.
Right.
It did, of course, take a lot longer to ultimately build a nationwide rail system. Doesn't mean it's not going to take as long here as well, Aswath, but it also doesn't mean that there shouldn't necessarily be a lot of capital invested and a lot of speculation, I would assume, around what this is all going to ultimately result in.
It's a feature, not a bug. I'm not saying it's a bad thing, but I think it's the nature of every revolutionary change that we get ahead of ourselves. That's what allows change to happen. Human beings are overconfident, overreaching. So this is the thing that concerns me is twofold. One is that it's happening so quickly. I mean, railroads took decades to unfold. So if there was displacement, there was a way in which you could deal with the displacement. But this is happening in 3, 4, 5, 6 years. And if AI's dreams come true, everything's going to unfold in the next 2 or 3 or 4 years. That I don't think we can take as an economy, that amount of displacement that quickly. So I'm not arguing that you shouldn't invest a lot in AI, but I'd like to temper the storytelling here because I think the rest of the world has to be brought into the story. If this story is as big as you claim it is, then the rest of us are affected by it as well. And our behavior is going to change. And that's what's not being built into these models.
Yeah, well, and it may also be reflected already in some of the fears that are fueling the opposition to data centers. Not necessarily just about power and water or even land. There is also just this idea, I would assume you agree, that, well, what are we really getting ourselves into here?
And I think AI needs to fill in that gap. I think they need to, if they let the story continue with the negative narrative it has right now, I mean, they're like the tobacco business then. Everybody thinks you're a bad business, and no matter how much you try, you can't get over that. AI needs something to change that storyline. I mean, and I think that's why you see stories like it'll come up with a cure for cancer or something that changes storyline to make it positive again, because right now the trend line is not good for AI as a story.
Okay. Aswath, always appreciated. Thank you.
Thank you.
Coming up, President Trump's beef import plan facing blowback from ranchers, and we'll be joined by the head of the National Cattlemen's Beef Association to explain why.
And as Wall Street weighs signs of mounting economic strain and rising bond market fears, just what to expect from Fed Chairman Warsh's Jackson Hole keynote later this week. We'll discuss that with a former Philly Fed president, Patrick Harker.
The Nasdaq heading lower this morning with chip and memory names leading the declines. Oil prices are also down as investors await Treasury Secretary Bessent's new package of sanctions against Iran later today. And gold prices rising to their highest level in over 3 months.
All right, let's get a news update. Frank Holland has that for us. Frank.
Hey, good morning, David. House Minority Leader Hakeem Jeffries and Jared Kushner, the president's son-in-law, they met in recent weeks. That's according to a person that's familiar with the situation who described that conversation as covering a broad range of topics. The timing coming just ahead of the midterm elections with control of the House at stake. Jeffries is in line to be the speaker should the Democrats retake the chamber. Ukrainian President Vladimir Zelensky said today there will be talks with Russia over the Black Sea. The comments come after he said this weekend that he had offered Russia a truce on attacks against ships traveling the Black Sea, but the Kremlin rejected it because they also wanted guarantees against strikes on energy infrastructure. The Federal Trade Commission and a group of states announced a settlement today with Zillow, ending claims that the real estate platform paid Redfin $100 million to stop competing in apartment rental listings. The FTC argued that the agreement between the two companies drove up costs for landlords, and it also lowered the quality of listings for renters. David, back over to you.
Okay, Frank, thank you.
Thank you.
Coming up, the CEO of the National Cattlemen's Beef Association is going to join us. We'll discuss that group's reaction to President Trump's plan to lower beef prices. We're back in a moment. Welcome back. President Trump recently announcing a plan to ease beef tariffs. Pippa Stevens joins us. She has the latest on that. Pippa.
Hey, David. So we're still awaiting an executive order for more details, but President Trump saying the U.S. will allow an additional 300,000 metric tons of beef imports at lower tariff rates, a move that he said will lower prices for Americans while helping the ranching industry. But ranchers pushing back on that, with the U.S. Cattlemen's Association saying, quote, "You don't put America first by putting U.S. cattle producers last." It's also unclear if this will have a big impact on price. For one, this isn't a massive volume, given daily U.S. beef demand is 35,000 metric tons. Additionally, our imported beef is primarily frozen, meaning it goes to the food service industry, while what consumers buy at the grocery store is primarily freshly ground beef. Consensus Ag's Carl Setzer telling me this move heavily favors the packers, who can now import at a discount over the ranchers. Now, we are entering a seasonally weaker period for beef after the busy summer grilling season, which could temper the increase we've seen in beef prices, up more than 9% in the last year. But this move by the administration doesn't address the underlying issue behind the price increase, which is that the U.S. herd is now at its lowest level in some 75 years. Leslie?
Yeah, that is the key question there, Pippa. Thank you. The National Cattlemen's Beef Association speaking out against the new beef imports, saying they undermine American farmers as they make critical decisions about rebuilding their herds. Let's bring in Colin Woodall, CEO of the National Cattlemen's Beef Association. Good to see you, Colin. So given everything that Pippa laid out about just the lowest herd levels in decades at this point, what can the government be doing to increase the size of those herds?
So there's always more to the story, and Pippa's right. We do have the lowest cattle herd that we have had in 70 years. And no doubt that is having an impact on our industry. But what we're really seeing is just the incredible demand from Americans for beef. It is something that we as cattle producers have been working on for generations now to improve the quality of our cattle, to improve the quality of our beef. And today we are producing the highest quality beef we ever have. And that is what is driving this demand. And with simple economics, when you have that increase in demand, you're going to have an increase in price. And unfortunately, I believe the president has lost that particular part of the story.
Going back to the tariff question, this seems basically like a pure play case study on what happens with tariffs in a commodity. But you also have 80% of the beef that Americans consume produced right here in the U.S. So how much of an impact on price do you think this change will really have? Do you think it will serve to bring down prices?
Much like the previous two times the president has proffered this, we doubt that it's going to make any impact at all. But it is going to have an impact on cow-calf producers. These are the farmers and ranchers across the United States that are going into the fall. And the fall is a very critical part of our production cycle, where producers are trying to decide whether or not they're going to market all of their cattle, or if they're going to keep some of their cattle back in hoping to expand the herd. And that's actually an area where we, as the National Cattlemen's Beef Association, the president, agree. We want to grow that herd. But every time the president makes a statement like this, every time there is some sort of announcement, he introduces uncertainty. And the last thing in the world that cattle markets like is uncertainty. And so if you're a producer last Friday or over the weekend trying to decide if you're going to hold back your heifers, you may now decide to send those cattle to market now rather than holding them back. And that just sets all of us back in trying to rebuild this herd.
Which, has an impact on herd size moving forward, right?
That's exactly right. We want to grow the herd, and that is something that we are committed to because demand is so great. But in order to grow the herd, you need three things. You need demand, which is good. You need solid cattle prices, which are still good, even though they get hit every time the president makes one of these announcements. And then you need rain. And that's where we have been lacking, is while there is some good rain and grass in the United States, there's still a lot of this country that is under drought. And until we have consistent rainfall and green grass, there's going to be a lot of hesitation to grow, because the only way you can grow your herd is to have something to feed your herd. So the best thing that the president could do right now is just try to take the regulatory burden off of us as producers, and more importantly, pray for rain.
Yeah, well, that's one thing I don't think he can control is the weather. I am curious, how long will it take? Are we really at the lowest point since, I guess, the 1950s? And what are we talking about in terms of growing the herd, in your opinion, and what would be sort of the right number?
we would love to be able to grow it as large as we can. We don't have a target we're looking for. We want to have as many cattle produced here as we can because we want to make sure that we are giving opportunities to cattle producers today and in the future and people who want to get in the business. So we're not going to set a cap. We just know that right now we need to grow. We want to grow. But even if we were to find a little harmony here, if this was the last announcement that kind of sent the markets into chaos and we started to rebuild, even if we started that today, at the very least, it's 2 years from now, if not more, before that beef ends up on the plate. And that is just a function of Mother Nature and the way that the cattle life cycle works. So it's going to take us a while. And that's why I say every time an announcement like this sets us back, all the president is doing is further compounding our situation and making it harder for us to grow.
Well, it sounds like the demand side is there. What's driving that now? Is it the prevalence of GLP-1s and the focus on eating protein? And how much of that do you think is a trend?
Oh, so that's a great question. I think most of it is based upon flavor. The beef that you eat today is not the same beef that you were eating 10 years ago. The percentage of beef that is being graded as prime, we have more of that than we've ever had. And most people are aware of prime. A lot of times you could only find prime graded beef in a white tablecloth restaurant. Today, you can find prime graded beef in Costco or in Sam's. So that way the consumer can go, they can buy it on their way home and have an outstanding eating experience. That's driving it more than anything else. GLP-1s no doubt have had a significant influence not only on us, but all meat proteins. And is that a trend for GLP-1s? I don't know. I can't speak to that. Is it a trend for us to continue to improve the quality of beef? You bet it is, because we have been working on continual improvement for generations, and we're going to continue to focus on making our cattle better and making that quality of beef even tastier.
And if the moves on the tariff front don't have the desired effect to bring down the cost of beef, do you see the administration reversing them? Have you been in contact with the White House?
I don't have any insight into what the president has on his mind on this. All I know is that we continue to tell him that beef is not like eggs. If you recall, when he was inaugurated, eggs were at one of their highest prices ever, and that was because of high-path avian influenza. And the president made it very clear to Secretary Rollins that she needed to bring the price of eggs down. When you need an egg, you need an egg. There aren't very many alternatives to those. But when you look at meat protein, there's a lot of alternatives to beef. You can buy pork, you can buy chicken, you can buy turkey. So this is not like the egg situation. And I think that's what's in the president's head, because Americans don't have to buy beef. They want to buy beef, and they want to buy beef because of the quality. And that's why this is a completely different conversation, and why we would really wish the president would quit just introducing chaos into the marketplace.
Fascinating. Colin, thanks so much.
Thanks for having me.
Still ahead, former Philly Fed President Patrick Harker will join us. This ahead, of course, of Jackson Hole later this week. We'll get his expectations for Fed Chairman Warsh's keynote and rate policy at large. We're back in a moment. Welcome back. The Federal Reserve set to kick off its annual Economic Policy Symposium in Jackson Hole. That'll be later this week. Joining us with what to expect is former Philadelphia Fed President Patrick Harker. Patrick, good to have you. There is some expectation we're not going to get much of anything given Warsh's reticence. What are yours?
Yeah, so he does not like forward guidance, that's for sure. He doesn't put a dot on the dot plot. But I do think he has to address the three elephants in that room. It's not a very big room, but there are three. One is clearly inflation. He's got to say something about this. He can't just keep saying, we're committed to bringing it down. That went over poorly at his last press conference. He's going to have to address it. He may not give forward guidance, but he's got to say something. Second, he has to talk about what's going on in the Treasury market and the limits of what the Fed is willing to do there. That's really important. And third, the biggest of all the elephants in the room, we got into this situation in the Treasury market because of the fiscal situation we're in. And, what we're doing right now, what Secretary Bessent's doing right now, is that buyback is building a bridge. But, somebody's got to actually build the road to solve the fiscal problems.
Yeah. All right. Well, you say he's got to answer these three questions, but what if he doesn't?
Well, I think the markets will react again. That's what they're expecting. They're expecting something on at least two of those three, and I would say all three.
It comes also, Jackson Hole, it feels like an inflection point in terms of the strategy between Treasury and the Fed. I think Bill Dudley had a nice piece titled this morning, quote, "The Perils of an Interventionist Treasury and a Passive Fed." How does that change the calculus of what we're going to expect to see later this week from Jackson Hole?
Well, I mean, the Fed should be, and I hope they are, consistent. You can't be in the business of, say, getting into the buyback program, which some would label QE, but it isn't that. At the same time, saying you're going to go fight the good fight on inflation. At best, they need to hold rates where they are right now. We have not solved the inflation problem. And there are going to be some of my former colleagues who will want to raise. As we saw, we had 3 dissents, but 2 others have come out publicly and said they wanted to raise. I understand their position. And so he cannot be buying treasuries and at the same time trying to say he's tough on inflation. That doesn't fly.
Are Bessent and Warsh sort of on opposite sides here? And I mean, I'm curious as to whether you could posit any guesses in terms of the dynamic between those two right now.
Yeah, I can't. Honestly, I think Jay's just taking a back seat, trying to just be a good citizen. Let the new chair be the new chair. He's not trying to be a shadow chair. I'm pretty sure of that.
Our Steve Leisman reported the story this morning that Treasury could use the near $1 trillion general account to help fund some of these buyback plans. What's your take on that strategy, especially in light of that $40 trillion debt that we surpassed last week?
Sure, it could, right? But we've got to address the fiscal issue, and that's not going to solve it. I mean, take, for example, the $4 billion we're talking about. That's equivalent to 16 hours of federal expenditure every day. That is just a drop in the bucket. So, could they spend the whole $1 trillion here? Sure. Is it going to solve the fundamental problem? No. At some point, we've got to deal with bending the curve in terms of our debt and deficits. We're hitting a point, my colleagues at the Penn Wharton Budget Model have estimated that around 2045, 2051, depending on your estimate of healthcare productivity, we're going to hit a point of no return where we're not going to be able to recover from this. We have time, but we've got to start solving this problem now, because if we put it off, it gets harder to solve later.
Yeah. Well, if Warsh does even address it, what would be your expectation in terms of what he might say?
Yeah. So there is this unwritten rule in the Fed, right? You don't criticize the fiscal side. Right. You take it as a given. I think we're in a situation right now where Jay talked about it some in Jackson Hole before. So it's not unprecedented for chairs to speak about the fiscal issue. I think he has to address that here.
And earlier, Patrick, I was asking about Bessent and Warsh, who seem to be on opposite sides. Not Jay.
Oh, yeah.
I'm curious. I mean, your thoughts about that right now, in terms, particularly when it comes to the Treasury market and rates.
So again, I understand what the secretary's trying to do. It's pretty clear, right? This is where independence of the Fed is really important. The Fed needs to be able to say no. And that's why that means independence. That is independence.
I mean, if history's any guide, Bush is not going to do what you expect him to here, or at least hope he does. You know, and I'm just curious. I know you said you expect there'll be a reaction in the market. What would it be if, in fact, he disappoints you in terms of what he's willing to say?
Well, if he even, I mean, so people are going to be reading between the lines of the lines, right? In that case, and you know, if nature abhors a vacuum, so if he doesn't say anything, people are going to fill in the blanks. And people are going to fill in the blanks by talking to everybody. You know what Jackson Hole's like. The media is there. Everybody's talking all the time. The former Fed people, the current Fed people, everybody's going to be looking for signals there. And I think that's a mistake. I think this is the one opportunity for the chair to speak plainly and forcefully.
Okay. Well, you got my attention. I'm going to be paying even closer attention. Patrick, appreciate your time. Thank you.
Mm-hmm.
Still ahead, a new lawsuit over New York City Mayor Mamdani's plan for government-owned grocery stores. We'll bring you that story right after the break. Welcome back. A local business group is suing over New York City Mayor Mamdani's plan to open government-owned grocery stores. Brandon Gomez joins with more. Brandon.
Hey, good morning, Leslie. The Multicultural Business Coalition, representing grocers and bodegas, arguing the plan would create unfair competition. The economics at the heart of the fight. The mayor has committed $70 million to launch 5 stores that offer core basket items at a 30% discount below market price. Now, customers at the stores are estimated to save $1,000 per year, and operators would also receive free rent and subsidies. But the coalition argues those subsidies give a city-backed competitor an advantage over independent operators. Now, the mayor's office has tried to address some of those concerns. City stores won't sell alcohol, cigarettes, or lottery tickets, important revenue sources for many bodegas. Discounts only apply to core basket items. Mayor Mamdani just now in a press conference addressing the criticism further, citing existing success models in the city.
We've seen, in fact, with Essex Street Market in Manhattan, as well as Moore Street Market in Brooklyn, a model where the city has subsidized groceries and it has not had a negative effect on bodegas around them or on grocery stores around them. And I'm confident both in the legality of this, that it will stand up in court, and in the importance of delivering it.
Now, yes, this is a local debate, but at first, the stores aren't expected for several years. We've already heard from some of the country's largest grocers on how foodborne illness outbreaks have been weighing on sales. Consumers are seeking lower prices. Margins are already tight in the industry. Now, we hear from Dollar General and Dollar Tree later this week, which have become increasingly vital players in the grocery trade-down effect. So it'll be interesting to hear how the consumer is shifting in this current environment, guys.
What are the expectations on the analyst front for those 2 names?
For Dollar Tree and for Dollar General. Yeah, so on the grocery front, again, the expectation is that they're going to sort of see more of this trade-in effect. Again, these Dollar Tree and Dollar General names calling it trade-in as consumers are sort of looking for more affordable options. And again, we'll get those names. I believe it's on Wednesday and Thursday of this week, Leslie.
All right, Brandon, thank you so much. Brandon Gomez for us. And those margins already pretty thin, as he mentioned. So we'll see kind of how this plays out nationally. Obviously, in a politically sensitive environment. I know you guys talked a lot in the 9 about just the data center backlash. Yep. Texas coming out against it, which caught my eye this morning.
Well, the governor there at least sort of backing off what has been his, full-throated support, of course, not that long ago for data centers. It's an important sort of story in the overall market as well. We are seeing some weakness in some of the names that you might expect, given that growing potential opposition. What that really will mean, though, Leslie, of course, has so much related to the AI trade remains somewhat unclear.
Yeah, Kate Rooney reported on Friday that one of the key questions that investors are fielding to Anthropic as it does its testing the waters meetings involves that data center backlash and what it means for their ability to really meet their targets, their growth targets, that being kind of a key concern already as that IPO maybe around the corner.
Yes, can't wait to see that S1. That does it for us here on Squawk on the Street. Time to send it over to Scott Wapner for the halftime report.
All right, David, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour, this pivotal week for stocks. NVIDIA reporting, the Fed chair speaking, and Tim Cook spends his final week as Apple CEO. We discuss, debate all of it with the investment committee, as always. Joining me for the hour, Joe Terranova, Shannon Saccocia, Jim Lebenthal, Steve Weiss. Take a look at the majors here. We are mostly red. The Dow is eking out a little bit of a gain here. Obviously, we have a huge week ahead, and everybody knows what's at stake on all fronts. NVIDIA's report, the chair war speech on Friday from Jackson Hole, especially given what's been happening in the bond market. Let's take a look at yields, because yields are lower today on a report by our very own senior economics reporter, Steve Leisman, that Secretary Bessent could tap the $1 trillion Treasury General account to fund the buybacks. Here's the president from later on Friday when asked about the administration's efforts to get yields down.
Did you direct Secretary Bessent to intervene in the bond market? Was
No,
that your idea?
not at all. No, he's a very capable man. He wanted to do it. He's very good at it. He has a good touch, very good natural touch for the bonds and interest, and he did that, yeah.
The yields have come back up since then. Have you talked to him about another type of intervention? Is that something he will be doing?
We have many types of intervention. That's one. The ultimate intervention is our military. And if we have to use that, we will.
All right. Well, that was on Friday. Social media had a field day, obviously, on that. We figured we'd ask our former Navy man.
Go that way with this.
What would we call that operation, Jim?
I don't know, because I don't know who the enemy is. I mean, Operation Anti-Bond Vigilante?
Vigilante Fury?
Vigilante Fury,
Zero
I like
Dark
that.
30 year?
Here's a side note. The vigilantes are not in one geographic location where you can bomb them from the air. They're dispersed. There are many people. It's hard to identify them. I truly don't know what he means by that. Now, we all know that he wants to get interest rates down. We want to get interest rates down. I think this is a time to actually focus on getting the job done and talking a lot less, doing a lot less bluster. And there are things that are going on right now that need to continue, like the Iran blockade. That needs to continue. That's being very successful. And we'll hear from Treasury Secretary Bessent today on what these sanctions are that are going to be announced, all of which should eventually drive Iran to the negotiating table and bring oil down with it. But we have an interest rate problem right now. We have an inflation problem right now. We don't quite know where the Fed is in all of this. And Scott, yes, I'm looking forward to Friday. We'll get some more information. How much, we don't know, but certainly Kevin Warsh should give us some information on what his thought process is, what the FOMC's thought process is. But right now is a time to stop the bluster, stop the talking, and get things done.
Well, Weiss, the Leisman breaking news today had at least a bit of an impact on the market. It's taken the edge a little bit off of yields, but we're still so focused on that, obviously, as is the administration. That's clear. And it does up the ante for what Chair Warsh is thinking about heading into this speech on Friday. Wolfe Research today says, when rates bite, that's the title of their note, a 10-year above 5% would accelerate headwinds for stocks. Jonathan Krinsky at BTIG, bonds versus stocks is in a staring contest. Who blinks first? So how are you thinking about all of this?
Well, what's the most interesting part of it is that you could have Warsh at odds with Bessent in terms of what they're trying to do with monetary policy, as you go forward. So Warsh is one to let the markets take care of itself. You said that, but with intervention, which is generally short term. And the only reason you do intervention is that you hope you're going to do it for a short enough period where the facts that really drive the economy and drive rates can take over. We don't know if that's clear or not. So I'm thinking about it just another wall of worry to climb. We've got many others, and I'm not so sure that what Bessent announces today will calm the oil markets, because the Iranians have shown a willingness to attack oil infrastructure in other countries. So for me, this puts the market on pause, that we trade in a narrow range, that we've got the other critical event, NVIDIA, which arguably will drive a good part of market reaction in advance of Jackson Hole, because NVIDIA is expected to, again, have another great quarter. It's expected the stock will trade off after the quarter, but put that aside, what does it do to the rest of the AI complex? So that is up first and perhaps the most important. So going into that, I just think the market trades here and there, doesn't really make a statement either way.
I mean, cyclicals haven't traded all that great, as we've been fixated more on this backup in yields. You look at what industrials did last week, they're in the red again. If they're declaring war on higher rates, the question is, what can they really do about it? Leisman's reporting, again, is significant, that they have a lot of firepower. Okay, if you want to continue the discussion about that, the secretary thinks that he's got a really big toolbox that he can deal with. How are you thinking about it in terms of what is, I think, undoubtedly a critical week for the next direction of this bull market? What you get from NVIDIA and what you get at the very end of the week from Chair Warsh.
It's an important week because I believe that the momentum, quote unquote, AI trade needs a shot of adrenaline. And it seems as though we've had several attempts during this quarter to rebuild the positive momentum in that AI memory semiconductor trade, and it's stalled out and it's failed. And the longer that you go on with the inability not to rebuild that momentum, the more concerning it ultimately becomes. It also becomes the prospect of now you're just relying on that cyclical component of the market, that broadening out narrative, the equal weight leading the charge forward, energy, healthcare, which has been really strong lately. I'm not so sure the market can do that So I think we need that shot of adrenaline this week, whether it's from NVIDIA or some news that we might get out of Jackson Hole or even news from the Treasury itself. Look, as it relates, just real quick on bonds, you have to understand we're at a moment in time that's unprecedented, Scott, because we began the build out of this AI innovation utilizing free cash flow, and now we're utilizing debt. And you have to expect that will send tremors into the Treasury market because there's a price sensitivity to the private sector that's the purchaser of that debt. So give me comfort that what will be a lot of debt coming forward from these AI companies that will be able to execute and transact easily, and then I think the Treasury market will feel better.
So we said it, if nothing else, it ups the ante on the speech later this week at Jackson Hole. What does he need, the Fed chairman, what does he need to say about future policy? Does he clarify certain things that are in question by the markets on how they plan to get from point A to point B? Things that are hanging out there that have made, I think, the markets a little bit uncomfortable as they try and get used to what is this new regime and the changes that Chair Warsh would like to make. So Morgan Stanley says, say less. We expect silence on the near-term outlook for monetary policy, including the expansion of the Treasury buyback program. That's an interesting take. I want to take that and then move beyond that to get to NVIDIA. Because if Morgan Stanley says Chair Warsh is going to have silence and he's going to say less, NVIDIA is not going to get away with saying less. And if anything, right now, I think we need Jensen Huang to say a little more. You know the numbers are going to be good. You know the outlook's going to be good. But there are questions hanging out there about the AI trade from here. What do you think's on the line with that report on Wednesday?
Well, I think that Joe made a great point about momentum, but most importantly about NVIDIA, Scott, is what you just said. Beat and raise on core data center business, not going to be enough for NVIDIA this Friday. And I think that there's going to be three things that investors are going to really focus on. Number one, they're going to focus on gross margins, right? Because we're in an environment where that inflationary impact, we may be losing that in areas of services. We're certainly more concerned about, though, on the AI trade and that inflation and what that does to the profitability of some of these companies. Number two, there's been a lot of announcements coming out of NVIDIA over the last several months around financing. There's some revenue that could come along with some of that, some revenue share that could come along with those financing deals that could be accretive from a revenue perspective. The last thing is this open model question and how much of the open model is going to become the sort of go-to, if you will, over the course of the next several years. NVIDIA's comments on that, I do think, could catalyze some additional interest in some of these other areas of AI and perhaps create some directionality, at least for the next 4 to 6 weeks.
So 300 is the target at Rothschild as they list the near-term concerns around the name. China and the export policy related to it. The law of large numbers eventually decelerating, right? And once you get to the top of the mountain, even if you're still feeling pretty good and able to continue climbing, I don't know, at some point you're going to decelerate. Circular financing scrutiny, that seems to be a real point of issue. And then the sustainability of AI CapEx, that is what's hanging out there. Amid a stock, by the way, that had this incredible rebound, and then that's sort of fizzled out. Six straight down days. That's the longest losing streak since September of 2022. As the Wall Street Journal writes a piece today that says Wall Street's counting on NVIDIA to keep the AI party going. Other stories out there today about potential price hikes. Christina Partsinevelos follows the company as closely as anybody. Joins us now with a little bit on that story, but on what they really need to deliver. I said, playing off of the bond note from Morgan Stanley and Chair Warsh, there is no stay silent from Jensen Huang. What does he need, do you think, to say on this call on Wednesday to answer some of the questions that are out there that you and others are asking about what this company is doing right now and what it will continue to do?
Yeah, it's not only just about the sustainability of demand, but it's just demand being that much more in the next few years. And the strange thing you guys highlighted is this print isn't really about the numbers. They're not necessarily the story because the beat is basically assumed demand surging, lead times have stretched from 6 weeks a quarter ago to nearly 40, and every major desk on the street expects another beat and raise. You were just going through the notes. I have so many of them right here. But NVIDIA has fallen the day after earnings 4 quarters in a row, even while beating every single time. And it's coming down in cold down almost 7 straight days into the report. You just talked about that stat, Scott. But what Wall Street actually wants is the guide. The buy side is looking for next quarter revenue well above $109 billion, the first real read on how fast the new Rubin chips are ramping. So this is the next iteration. Behind that, Shannon mentioned it, margins. Memory prices spiking. The question is whether NVIDIA can hold that mid-70s number into next year or give some back. We know that the reported increasing prices anywhere between 15 and 17% for Blackwell's Rubin platforms as well. Then there's the thing that's really hung over the stock all summer, circular financing, lining up more than, $500 billion in financing with Wall Street, 6 financiers. It's backstopping up to $105 billion of an OpenAI data center in Ohio. It's taken stakes in dozens of AI startups. Even supporters saying that locks in demand, but critics say it's a loop that makes the growth look better than it is. Either way, investors want to know how much of NVIDIA's own balance sheet is on the line. And to Shannon's point about all of the investments, the problem is NVIDIA's investing now, making these promises. We don't know when that return will actually follow through. You know, the smaller labs will get the financing, they'll buy the chips, but this is going to be, further down the road. So I think that's what NVIDIA is going to play up, that they're investing in so many of these smaller firms. That's going to help demand stay strong for years to come. But will that convince the market, especially with the stock that has sold off for quite some time now?
Yep. Christina, thank you very much for that. That's Christina Partsinevelos, really setting the stage, the scene, and whatever else for what's going to happen this week. There are other reports today. NVIDIA discussing a Perplexity investment, according to the information, $30 billion plus valuation for Perplexity, which, at the rewind like a year or so, 2 years ago, it felt like sort of Perplexity was really deep in this conversation. Doesn't feel so much that way because OpenAI and Anthropic have taken all the oxygen. Yes. But that would be an interesting move. They're also spending $6 billion to build a U.S. alternative to Chinese AI, according to the Wall Street Journal. But as you think about the shares that you own, again, remember this 2 weeks ago, the stock had made this incredible move back, right? Okay. And then here we are talking about 6 down days in a row. I don't know what that does for expectations into the print, but
that's the pattern. So stay on that for a second. The last 4 quarters, 30 days prior to the earnings report, you see the spike in shares for NVIDIA. You see a lot of call buying. The anticipation, the understanding, as concurrent with that, the analyst community comes out and begins to put out those reports telling you overwhelmingly what a phenomenal quarter this is going to be for the company. So I think you pull forward a lot of the positive return potential. That's been the pattern over the last year or so. It doesn't mean on the other side of earnings there's something very ominous. It's just as though the price excitement really comes in front of you. I think that's what we're faced with here today. I also wonder, when you mentioned what is it exactly that Jensen Huang has to address, I wonder if he has to take a turn into discussing this relationship that the states now have with data centers and understanding what those relationships ultimately might look like.
Okay, that's a good point.
He's right there at the center of it.
So I've been asking, Weiss, I'll ask you this question because I've asked others, whether it's this program or Closing Bell, and I did this past Friday too to Professor Siegel and Tom Lee as to whether this now spreading backlash towards data centers is, at least in some degree, this existential issue for this AI trade, which may be having a negative impact on NVIDIA and the way it's traded over the last 6 days, which may be impacting the way the momentum trade has gone lately and is only going to get louder as the midterms get closer.
Yeah, I think it is. Clearly, when we saw the announcement come out last week, had an immediate impact on the stocks. And I think that is going to continue. I think longer term, it's a good thing because there are a number of people I speak to, and I'm one who believe this, that you're overbuilding for data centers. If all the plans came to fruition, there'd be too much capacity. So it's actually going to be good for the data centers in terms of what they can charge, in terms of compute, et cetera. However, I think the biggest issue, and everybody's mentioned it, but the biggest issue right now for NVIDIA, in my view, is all their commitments. We don't know what those contracts say. Are there milestones to the funding that they're giving out? Are they truly bringing in demand? I mean, if I offer low-cost financing to somebody to do something, they're going to take it, whether or not they actually have demand for it. And then there's the double and triple ordering that always happens when you've got a cycle like this, and that includes in memory. So I personally think for the near term, regardless of what NVIDIA says, we've seen the peak in AI euphoria, and we'll see that valuations will come down as they are with CAT and others that still have these inflated multiples based upon the euphoria over AI. So I'm not saying they won't at some point revisit the highs. We saw that early last week. They recovered nicely, but I do not believe you'll see a sustained move higher, regardless of what Jensen Huang says.
The semis haven't traded all that well, more broadly as we've talked about. I thought last week's comment by the Micron CEO with Kramer, who was doing that interview, and this notion that semis or memory specifically is no longer a commodity, I thought was as important a comment as we've heard from anybody in this space. I mean, you could say, well, of course, what do you think he's going to say? He's talking his book. Maybe. But that's still a pretty profound statement, because it definitely impacts the way that investors, he thinks, should think about valuations today versus historically. Typically, a historically cyclical trade, which some are trying to make the case is now a secular grower, or at least the cycle has been tremendously elongated.
That's where I am. That this is an incredibly elongated cycle, which may look a lot like a secular change. And frankly, if that's the case, I don't care. I look at a stock like Micron, which you're bringing up, Scott, at roughly 6 times forward earnings, and I say, if this is an elongated cycle, or if this is a secular change, that's way too cheap. 6 times forward earnings is implying that the cycle is going to change and go negative in the next 6 to 12 months, which I just don't see happening. By the way, one could extend that valuation argument to NVIDIA, which we were just talking about. I know it's a higher number at roughly 19 times forward earnings, but the growth rate of that earnings is roughly 35%, PEG ratio of 0.5. Everybody knows I like the PEG ratio below 1. The point being is that it almost doesn't matter. In fact, it doesn't matter whether this is an elongated cycle or a secular change. These stocks are cheap right now. What is concerning, Scott, and you started with this, is how rapidly this rotation is going on. It was just Wednesday afternoon that we had Micron up about 1,050, and now it's in the low 900s. I will tell you, the value of Micron as a company hasn't gone down by 10% in the last 4 days. That's just not what happens. The market may be trading perhaps in anticipation of NVIDIA's earnings, but if you're a long-term investor, I don't care if it's NVIDIA or Micron, these are buys right here.
Okay, well, how about another name which, for some reason, doesn't feel like it's getting talked about enough, strangely enough. And I'm not going to say it's been a stealth mover, because if I told you it was up 170% year to date, you're like, well, how would that be stealth? But if we spend most of our time talking about NVIDIA and SK Hynix and Micron, why aren't we talking more about Marvell? Because Wolf says if we had to own one name, this would be it. There's the stock. Year to date, they report this week too. You can make the case equally as important as anything that's coming down the pike, because this has been a critical AI trade. The target to 224 today, that's equal weight. So the stock's had a lot of run. Morgan Stanley says, all right, so let's sort of temper the expectations for the moment, given that. 310 at Wells. You own the name. What do you think about Marvell? I think Stephanie Link's got the name.
Yes.
And you guys have watched this thing just take off.
It has been a remarkable story in the AI infrastructure build out, and really has replaced what we believed copper's position was in that food chain for the infrastructure build out. Optical fiber, Marvell is there. They have market share. They have strength of revenue growth from that. And they are positioning themselves with the hyperscalers with significant deals, significant relationships, so the hyperscalers can secure what ultimately has become a commodity. So I think that's the way you have to think about it, the way that we were thinking about memory towards the end of the second quarter. Now, you could extrapolate from that and say, well, okay, Joe, memory hasn't traded so well since we had that conversation about it being a commodity. But I think Marvell finds itself in the same place. And I agree with Jimmy. You have to have the outlook here and the understanding that this is a very long runway. And embedded within that runway is going to be hyper volatility and periods where you see stocks pull back 15 to 20%. You're going to have to size accordingly if you want to maintain the position, believing the fundamental thesis remains valid.
Final A Block story. Tim Cook begins his last week as Apple CEO. 15 years, the stock up 2,200%. It's had a pretty nice year as well. It's beaten the NASDAQ. Jimmy, I'm wondering what you think about this run, what it means for the name moving forward.
I think that picture right there, and we just went in close, but maybe we can zoom it back out. I mean, that's the legacy, up 2,200%. That's a hell of a chart. And I remember, and I think we all remember, that when Steve Jobs, unfortunately no longer with us, turned over the reins, that there were questions: who could possibly fill his shoes? Tim Cook did an excellent job, and there's, he came in as an operations guy. He did operations very well. There was this label said that he's not an innovator. Okay, so what? We've seen what the stock has done. You know what he's done particularly well in the last 2 years? Is manage politics in a very quiet way. And I have to give him a lot of credit for that. It's not easy in this environment. He has done it well, in my opinion, but at the end of the day, that stock chart is his legacy.
Sorry. How about the idea also that, if I told you, okay, well, Apple's ahead of the NASDAQ itself in year-to-date performance, they were so heavily criticized for being so late in the game to AI, and maybe their deliberateness in that was a virtue in the end, because they didn't spend money as crazily as some have suggested others have. They wanted to get it right. They didn't do some sort of dramatic deal trying to chase something down, go elephant hunting for something that may not have been the right move just to appease investors who were getting a little antsy and anxious. And now they find themselves, it feels like, in a pretty decent spot, assuming they can get this Siri rollout correct. And they'll do that under what is now going to be a company led by a product guy, so to speak, in John Ternus.
Yeah, it's interesting, and that's the perfect observation of what's happened. So they're not great communicators, Apple. They leave a lot to the imagination. So it wasn't in their interest, and this is the Tim Cook, I think. If you're going to look at what's the hallmark, it's what Jim says, doing things quietly. So did they say, let's wait on the sideline and see what emerges? So they've kept the integrity of their balance sheet, of their cash flow, and they kept the integrity of their operating model. And what they have to fall back on is such a huge installed base that it's so expensive in terms of upsetting individuals to switch to another platform, switch to the Galaxy, whatever. So that works for them. But then again, you take a look at, their announcements on Siri and how they're going to advance Siri, and they've continually fallen behind their own timeline. So I'd say part of it is luck, part of it is driven by their own strategy. But at the end of the day, I think people find safety in it. And they find safety in Apple because of the balance sheet, because of the brand name, and because most people in this country pick up their phone or one of their devices every day. So that's why the company stock continues to endure. So it'll be very interesting to see what happens now that we have truly a new regime who's going to be more product driven. So I own some. It's not a big position. I'm going to stay there. I want to see what transpires. But to me, this is always going to be the safe play in technology.
Well, he's still, as Tim Cook's going to be breathing all things Apple. There's no doubt about that. We wish him well, obviously, in this next stage of his personal and his corporate life, too. All right, up next, Bitcoin's big rally. We will debate if that rebound has legs. Others are opining on that question today. We do have some top calls of the day ahead as well.
We're back on Halftime Report. I am Frank Holland with the CNBC News update. The U.S. military says it struck a suspected drug trafficking boat in the Eastern Pacific, killing 2 people. It's the first announced attack in about 2 months. More than 210 people have died in the nearly year-long campaign, which critics question on legal grounds. The Pentagon offered no evidence the vessel carried drugs. San Francisco 49ers principal owner Jed York was arrested in Ohio on suspicion of engaging in prostitution. Court records show that charge was amended, and York pleaded no contest to misdemeanor disorderly conduct and possessing criminal tools. A judge imposed concurrent 1-day jail sentences and $1,150 in fines. And machines are breaking records at the World Humanoid Robot Games in Beijing. One robot beat Usain Bolt's 100-meter mark, and another bested the men's high jump record. More than 2,000 robots are competing in 51 events, including running, table tennis, soccer, and much more, showcasing China's rapid advances in robotics. Scott, back over to you.
All right, Frank. Thanks. Frank Holland. Let's hit some committee stocks on the move. First, we want to talk about Bitcoin, just to focus on what's been happening here. It has been a big rally, as you know, the biggest rally since 2023, up 14% in 1 week. Needham says it has legs. Does the crypto rebound? Weiss, you were in the IBIT. I'm wondering, are you looking at this again here? What are we thinking?
Yeah, I am looking at it again. It's obviously moved, as you pointed out, pretty far, pretty quickly. But right now, it looks like legislation is going to be a reality. It's got to happen before midterms. And when you've got a White House that is so personally invested in this space, you have to believe that's going to keep going positively. But you just don't know how to value it. There's no intrinsic value to it whatsoever. So you really do need the legislation, and you need those tailwinds to continue. So if it pulls back a little bit, or if it stabilizes here, I think I'll get back in. Remember, the prior peak was about 125. I don't know if we get there, but I do think there's some more room on it because it's a momentum instrument.
Okay. Wolf today is making a call on Gilead's technicals, Joe. They say a breakthrough in play. What do we think here? It's been a laggard amongst its peers, now improving in our trend model. What do you think? 157 they think is in play.
And moving back towards its high from earlier, 5-year high from earlier in February. You can see it there on the chart. You're beginning to build this momentum and this appeal to have ownership of biotech, in particular large cap biotech. Gilead fits in that narrative. I was looking today to see where we see the strongest momentum in the healthcare place. It's interesting because it's Incyte, it's Vertex, it's Amgen, it's Lilly. It really is the large cap bio pharma trade.
Is it Jim's AbbVie?
AbbVie, Vertex. I agree totally with Joe. Now, we know from a technical point of view that healthcare has been hot for the last several months. And within healthcare, pharma and biopharma, I look at Vertex as a great example. This is not a cheap stock. And frankly, that's what's held it back over the last year and a half. But now it's powering through. I think that has a lot more to do with technicals than anything else. The fundamentals haven't changed. It's been a great company all along. I think I can say the same about Gilead, Regeneron, and Amgen. These things are catching a bid. This is where the money's flowing. The fundamentals have consistently been there. The money is flowing there now.
Hey, Weiss, what's your current position in Moderna, given the news and the stock move of last week?
Yes, I've been looking at Moderna when it was trading in the 50s and 60s, never pulled the trigger. As soon as I saw the announcement pre-market, I bought it. I bought a decent size, but then the stock continued to move. It almost tripled on that day. And so I sold part of that. I still have a small position in it, and I'll look to add. Look, I had said years ago and did well in the stock back then it fell down to the 20s, don't forget, that it was going to be one of the best drug companies of all time. And I think what they came out on melanoma, which is cancer, it shows that it can be that. So the pipeline is very, very robust. And as they continue to meet milestones, it'll continue to move up. Now, the next big date is the EU Oncology Conference, where they'll give the full data on the 23rd to 27th of October. I expect to see a meaningful move in the stock leading up to that. But right now, it's still got to absorb that huge gain that it had last week.
Okay. Pulte upgraded to outperform, Joe. 158, the target there. What do you think?
No, I disagree. I'm sorry. We've had ownership here, and Pulte has been resilient, a little bit of relative outperformance in the home builder space. but we're becoming uncomfortable when you're statistically looking at the quality metric and you identify the sales growth. The sales growth is decelerating. Over the last 3 years, you're looking at a positive 3%. Over the last year, you're looking at negative 12%. That's consistent with the fundamental narrative.
Yeah, higher yields, higher mortgage rates.
Right.
And those are the sales you're talking about home sales, right?
Yes. Well, I'm talking about revenue growth. I'm talking about revenue growth for the company specific itself. That's where you're seeing the contraction. But of course, you're seeing the home sales decline as well.
Yeah, and incentives are going to remain necessary and are going to continue to cut into the revenue that these companies are going to be able to make on these home sales.
With a much tighter margin too, because of higher input costs as well, and it's difficult to kind of offset that.
How about Airbnb? Target goes to 217.
Interestingly
today.
enough,
Bernstein, outperformed.
Sorry.
It's okay. They say acceleration is here to stay.
Yeah,
we're up almost 30% in the last month alone. Let's look at a 1 month, guys, please. See that move. What do you think?
Really strong benefit from the World Cup. It's interesting, and I talked about this. Momentum really doesn't embed itself in the consumer discretionary sector. It kind of appears and then it removes itself, and it's difficult to allocate in that direction. Of the 9 consumer discretionary names that we own, 8 of them have negative momentum right now. This is the only name that has positive momentum. And remarkably, it's been on the resilient global traveler. And then in addition to that, the strength we saw from the World Cup.
Quickly on airlines, Delta's target gets cut 2 spots today. Cowen takes it to 105. Ray J goes to 98. You own it, but you own it too. So let's hear from you.
So the price cuts are just reflecting that the stocks themselves have come down over the last couple of weeks. That has a lot to do with Iran. Nonetheless, I think if you're looking at a 105 price target, you're looking at roughly a 25% gain. For Delta, that would be roughly 12 times earnings, about a 7% free cash flow yield. Yes, I think you get there in the next 12 months, a 25% return here.
By the way, United's target got cut today as well, just for keeping score, 192 at Cowen as well. Up next, ETF Edge, Dom Chu, the domino, what's coming up?
All right, Scott, so a lot of investor attention shifted away from company-specific earnings stories towards more macro, big picture related ones, from wars to trade to rates to currency valuations. We're going to dive into how all those things are shaping opportunities outside of U.S. stocks. That story coming up on ETF Edge on the Halftime Report, right back after this commercial break. Welcome back to ETF Edge on the halftime report. International markets continue their record outperformance run, but macro headwinds are mounting. So can they outrun those headwinds? Joining me now is David Botsett, the head of equity product and strategy over at Schwab Asset Management. This is an interesting conversation because international has kind of lagged. It's been the U.S. exceptionalism trade for such a long time. What exactly is driving all of the fund interest and flow into global equities outside of the U.S.?
I think, Dom, finally, investors are starting to see the benefit that can come along with international investing. You look back at years like 23 and 24, exactly what you said is so U.S. dominated. We really saw the resilience in international markets come back in 2025, and the outperformance of those international markets really drove a lot of investor interest in international index in products.
How much do ETF and fund investors at this stage have to scrutinize things like interest rates on the 10-year note in the U.S. and currency valuations, the dollar relative to the euro, yen, everything else out there?
I think it's less around that scrutinization, and it's more about thinking about the long-term strategic allocations they have in their portfolios. And we're starting to see that investors are understanding that benefit. Year to date, we've seen at Schwab Asset Management over $8 billion in index ETF and mutual fund flows to our products. Really, that's being led by SCHF, the product you have there on the screen, our international equity ETF, which is approaching $70 billion in assets today.
And before we let you go, which factor or two are the most key when it comes to looking at the types of international funds that you want to invest in for ETFs?
At Schwab Asset Management, we're always pushing low cost. That's the one thing that every investor controls in their portfolio. 3 basis points for SCHF is a great value. I think the other thing is a broad-based index. Rather than trying to make a specific tactical play in your portfolio, look at something that's broad-based beta exposure.
All right, we're going to continue this entire conversation over at etfedge.cnbc.com. David is going to be joined by Josh Jones, portfolio manager over at Boston Partners, manages a big equity ETF on the international side. Scott, I'll send things back over to you guys.
All right, Domino, thank you. Dom Chu up next. Options action. We're playing it with Oliver Rennick. He is looking at some of the day's biggest movers, and he's going to give you the trade next. Let's play some options action in Chicago at the Cboe Global Markets with Oliver Rennick. What do you see today?
Hey, Scott, someone is betting gold's best month since 2008 is coming to an end. In the biggest options trade on the tape this morning, someone sold over $200 million worth of 420 strike calls in GLD expiring September 18th, and then bought the same number in expiry of 430 strike calls for $144 million, giving them a net almost $60 million position with a break-even price of 425 in GLD by expiry in 4 weeks. Oftentimes, selling spreads reflects a neutral view, but since gold is trading above the break-even right now, this is technically a bearish trade, but it's more about gold running out of gas than reversing. Their gains are maxed out at 420. It's also worth pointing out that up until this trade, the flows were looking very bullish in GLD. 4 times more call buying than put buying today. But one could argue with real yields going up this month as well, this rally in gold perhaps has already gone against some conventional assumptions, Scott.
All right, well, we'll see what the trades are from the panel here. I'll see you at 3. Oliver, thank you. Oliver Rennick, you own Newmont.
I do.
What do you think about gold from here?
So we've had Newmont since April of 2025 at about $52. It appears to me that Newmont Mining specifically is about to break out above its January highs at 134. Now, Newmont Mining, the miners are ahead of gold itself. GLD just kind of crossed back above its critical moving averages. It's working towards rebuilding the momentum. I actually like the miners here a little bit better than I actually do the gold commodity, which is rare for me because generally I'll say buy the commodity.
You have a thought on gold?
Yeah, I mean, it seems like we're setting up here for another play in terms of investor flows coming in. You have to watch the central banks, especially in this environment, because they're continuing to try to diversify, and especially with the pressure on treasuries recently.
Let's look at the gold price itself, not the GLD, just for a moment. Jimmy, what about you?
Yeah, I mean, I think this is reflective of a reflation trade that is going on, or inflation, however you want to call it. While I'm not in gold particularly, I'm in other materials like steel, like concrete, aggregates, certainly energy. So I think this is all part of the overall idea that economic activity is picking up. Inflation is, while not out of sight, high, and whether it's gold, steel, or oil, you're going to feel it in all of those places.
He certainly is in steel. I think you're in the wrong one. The Steel Dynamics, Jimmy.
I'm going to quietly let the third quarter report come in, and we'll talk about it after that.
Okay. We won't look at the last
because,
5 years.
in all seriousness, I'll address it head on.
When is that?
Cleveland, that's not going to be until the end of October, but Cleveland Cliffs, I think, is coming out of the penalty box. It was deservedly in the penalty box. They had a pretty good second quarter and a pretty good outlook, and if they confirm that in the third quarter, Lorenzo, if you confirm that in the third quarter, you're out of the penalty box.
Can I ask you what you have against Steel Dynamics? 33% revenue growth, up 229% over the last 5 years, while Cleveland Cliffs has struggled.
Yeah.
And you and I have gone back and forth ad nauseum the last several years, and I can't get you to buy Steel Dynamics.
No, but I think this is a great discussion because as you're talking about quite often quality, right? So you're looking at the balance sheet and Steel Dynamics. Yes, balance sheets and the so-called impairment of it with Cleveland Cliffs is a risk, but if they come out of it, which I think they will, it's a heck of an opportunity. It's a huge opportunity. But this is a decision that one makes. You've said, I want to be in the higher quality balance sheet. Fine, go for it. I'm comfortable with what I know of the business model and the people running Cleveland Cliffs, taking the risk of the balance sheet.
That's uncharacteristic for you, though. Generally, you gravitate more towards quality.
You are correct, but if you can do the analysis and get comfortable with the business model, particularly for this company with a lot of things going on, grain-oriented, electrical steel, things like that, then you get comfortable with it.
All right, Mike Santoli, he's next. All right, we're back. Senior markets commentator and overtime co-anchor Michael Zantoli is here at Post 9 for his midday word. What are you thinking as we embark on this critical week?
It is critical. I think that because bonds are well behaved for the moment, it just revs up the market's dispersion engine, right? You have another downside test in semiconductors. The low today, down a few percent. It's right on the sort of trend line from March. So there's a lot of technical stuff going on. Are semis going to actually hurt the tape, or can we make it up somewhere else? We're making it up somewhere else. Mag 7's up 0.5% as a group. You have the Apple Contra trade. So that's working. And I do think that maybe last week's bond market chatter just got a little bit too loud and overheated, just given the magnitude of the moves and even the counter moves by Treasury. So we'll see. I think there's a case to be made that the bond market was kind of due for a bid anyway, and you had Treasury Secretary coming out maybe knowing you want to get on the right side of it and maybe see if you can slow the rise. I don't think it scrambled the whole equation for stocks in the economy, but it's pretty dicey internally in terms of where the market is feeling the rate pressure.
Yeah, high stakes this week. NVIDIA, share wars relative to rates and all that. I'll see you at 3. That's Mike Zantoli. We'll take a break. We'll come back with finals. All right, 3 o'clock closing bell. Dan Greenhouse, Stephanie Link, Courtney Garcia, Chris Verone. So I'll see you for the final hour of trade as we kick off what is a very important week, as you know. Stephen Weiss, what's your final trade?
Dick's Sporting Goods, look, I pared back the position, but right now it's pretty solid. They report tomorrow morning, so this is a high-risk call. But I think it's been so negative in the stock that I think it'll do well and actually be a good quarter.
This whole space has been kind of squirrely, hasn't it, lately?
Oh, it's been destroyed. So there are values there, and I think Dick's is one of the ones that you want to own going forward.
Okay, good stuff, Jimmy.
BlackRock quietly rallying. Looks like it's going to take out its 52-week high soon.
Shan?
Industrials, Joe mentioned the pressure earlier. Electrical equipment and data center is not the only name of the game here.
Charles Schwab is breaking out.
Okay, well, 2/3 of 1% today.
There you go.
All right, good stuff. I'll see you at 3. The exchange begins right now.
And welcome to the exchange, everybody. I am Brian, in for Kelly Evans today. And as you can see from the podium there to your right, Treasury Secretary Scott Bessent, all set to give a press conference in just a few minutes. When it begins, we will take it to you live. Now, Secretary Bessent expected to announce hardcore new sanctions against Iran. In an op-ed in the Financial Times over the weekend, Bessent promised a, quote, economic D-Day coming for Iran with the, quote, full weight of American resolve. Now, despite the risk of tougher sanctions, or maybe because of them, crude oil is actually lower right now, about 2%. Remember, if Iran is less able to sell its oil easily around the world, it might be forced to sell that oil on the black market, which means offering a discount. Of course, the risk to higher oil prices would be any scenario where less Iranian oil hits the global market. We will talk all about this extensively over the next 2 hours, of course, based on what Secretary Bessent says. Now, for stocks, the market's in your money. It's kind of a mixed market ahead of that press conference. Markets there, you can see Dow's up a little bit, markets down. Semiconductors, though, they're in focus. They're selling today. SanDisk, Western Digital, Seagate, all lower. NVIDIA, by the way, which has earnings on Wednesday night, is on pace for its 7th negative session in a row. Now, another big part of Bessent's talk may be about Treasury's bond buying plan. That is sending bonds up and yields down a little bit right now. Of course, Bessent would like to see yields move a lot lower. Steve Leisman has fresh exclusive reporting on just that. We also have Eamon Javers, who is in the lockup, kind of like a Federal Reserve meeting. You know, Eamon had to go away. We're going to hear from Eamon in a bit, Steve. But what can you tell us about Treasury and bonds?
Brian, thanks. CNBC has learned that the Treasury could use its near $1 trillion general account to help fund its recently announced plans to increase purchases of government bonds. That is according to senior Treasury officials who I spoke with. Using the Treasury general account, the TGA, think of it as the government's rainy day fund. It would provide the Treasury with considerable firepower to influence long-term bond yields if it so chose.
Steve Leisman. Steve, apologies. Let's go now to U.S. Treasury Secretary Scott Bessent.
Trump's direction, the United States Treasury has begun Operation Economic Outcast, an unprecedented campaign against the Islamic Republic of Iran and its enablers. In the Second World War, D-Day marked the historic beginning of a campaign with our allies to target and drive the enemy from its positions, including those in third countries. Today, in that same spirit, we are launching an economic onslaught against Iran's financial connections around the globe. Our objective is to sever every economic lifeline that sustains this tyrannical regime until Tehran stands alone. Iran's fanatics devote themselves to death to America and seek nuclear weapons to do just that. They have murdered and maimed more of our citizens and service members than any other terrorist regime on earth. And they have been at war against America, their neighbors in the Gulf, and much of the world for 47 years. President Trump has taken action that his predecessors have long deferred. And under his leadership, America is no longer managing the Iranian threat. We are ending it. Our great armed forces have laid the groundwork for achieving the president's objective of preventing Iran from ever obtaining nuclear weapons. They have shown America's resolve to finally end this threat. And the strength of America's economy under President Trump allows us to wage this sustained financial operation alongside the might of our military. Iran now faces a very clear choice with only two paths before them: complete global isolation and a subsistence economy, or a path back to normalcy with an opportunity to rejoin the global economy. Today, we are launching Operation Economic Outcast to foreclose every other option available to the Iranian regime. Treasury has mapped every node, every facilitator, and every network that Iran has used to smuggle oil and evade sanctions. Beginning today, the actions of Treasury and other agencies will tighten the noose and block every potential source of revenue that funds the IRGC and the evil Iranian regime. We are enforcing a zero leakage approach. There will be no minimal breathing space for the regime to rebuild its capacity to inflict terror against America and the world. The final refuge of this regime is the mistaken conclusion of nations that still finance the Iranian threat in the hopes of evading it. It is no longer acceptable to operate in the gray spaces of this conflict. Countries cannot claim they are blind to enabling this activity. Iran's enablers purchase, transport its petroleum. They facilitate the flow of its finances through exchange houses and free trade zones. They welcome Iran's flights and maintain registries on its behalf. They turn a blind eye to seaborne fuel transfers and overland transits. They condone illicit use of their banks, all the while concealing the extent of their complicity. The president is making phone calls to world leaders with specific requests to cease their interactions with the regime. We are already seeing results. Over the weekend, comments from Iranian leadership clearly acknowledged the effect of this campaign, and nations that facilitate any interactions with the regime should quickly heed our message. Those who stand with the United States will reap the rewards of our partnership. Those who tether themselves to the Iranian regime should expect to share in the isolation of a withering regime. Teams from Treasury, State, and the U.S. military are now meeting with their global counterparts to tell them that the United States expects action. Every country has a defined timeline to shut down activities we have identified. If they do not take action, we will do so unilaterally through Treasury authorities. For example, every branch of Bank Melay must be shuttered and dark. And let me be clear, any entity that facilitates money laundering on behalf of Iran will be removed from the US dollar system. The clock just started ticking. The new sectoral sanctions determinations issued today target 5 of Iran's most vital lifelines that it exploits in other countries: digital assets, technology, gold, aviation, and shipping. These measures broaden secondary sanctions risk for anyone foolish enough to continue conducting business with this regime, and will accelerate the speed with which we pursue them. As I speak, Treasury's Office of Foreign Assets Control is also sanctioning over 60 entities, individuals, and vessels around the world that enable the Iranian regime to procure illicit nuclear and missile technology, conduct cyber operations, and generate oil revenue. This is a sustained campaign to collapse every last option for Iran. Let there be no ambiguity as to the position of the United States. An economic engagement of any kind with this murderous regime will expose those responsible to the full reach of American power. For decades, this regime has drawn strength from a calculus that regards Iranian retaliation as certain and American enforcement as negotiable. Under President Trump, that era is over. To the ordinary soldiers supporting this regime, as more and more of your paychecks stop or are supposedly just delayed, ask whether your commanders are leading your country to triumph or to ruin. And recall that the Berlin Wall fell when ordinary soldiers decided not to shoot at their own people. And to those who enable Tehran, do not discount the cost of testing Washington's resolve. No nation should expect to enjoy the rewards of our system while helping those who seek to destroy it. It is now a time for world leaders to make a decision between prosperity and isolation, peace and terror, America and Iran. The campaign we begin today will gather force with every day that follows, and it will not end until this regime stands alone. With that, I welcome your questions. David from Reuters.
Hi, thanks, Secretary. One of the most powerful tools you have at your disposal is the ability to impose secondary sanctions on banks and financial institutions that facilitate transactions for Iran. Chinese banks have often been talked about being targeted, but we don't see any of those institutions targeted here. Is that something that is coming in this campaign, or is the very delicate trade truce with China something that could prohibit you from going that far and taking that very big step?
We want to make clear here today that no one is above the reach of U.S. sanctions, that if they facilitate transactions and are part of the ecosystem that turns Iranian oil into money, into repression, they will be targeted. We find that the best way to engage with countries is through quiet diplomacy, and we are level setting with every country to tell them our expectations. We know who they are, they know who they are, so when the hammer of U.S. Treasury actions falls upon them, they will have no one to blame but themselves. So, Richard from CBS.
Thank you, sir. Thank you. You said the president is calling world leaders with specific asks and that there is a defined timeline. Who is he calling and what are the asks?
We're not going to name names. That we've already seen some results, and that I am confident the president, as you all know, is quite persuasive, and we are following his calls up with calls from visits and calls from the State Department and from the U.S. Treasury, expecting them, or telling the leaders, the countries, and the entities exactly what we expect and the timelines. And I would expect that very quickly, if they do not respond, then you will see the ramifications of their actions.
Can you say how far the timelines are?
Again, I'm not going to set timelines, but we do not have infinite patience here. Jennifer?
Thank you so much, Mr. Secretary. Jennifer Schonberger with Yahoo Finance. You just said moments ago that no one is above U.S. sanctions. What specific secondary sanctions or penalties is Treasury prepared to levy against Chinese banks and shipping firms if they do not comply? And then secondly, as you look to take these unprecedented sanctions, you've also said that as the Iran conflict fades and oil prices recede, that will help bring down long-term bond yields. In the meantime, you have mentioned your toolkit, and I'm curious if you are looking at reducing auction sizes for longer-term dated Treasury debt going forward, and what other actions you may consider from that toolkit.
Yeah,
Thank you.
well, why don't we work backwards? We issued the quarterly refunding announcement 2.5 weeks ago. We are going to continue with our regular program of auctions, so you will be hearing from us again at the beginning of next quarter. In terms of, as I said, every country, every entity should know that they should be prepared to face U.S. sanctions. and no one is above this. We are going to hold everyone accountable, and this is economic asphyxiation of this regime. And Jennifer, as I said, no one should test our resolve. So, Josh from New York Post.
You said you weren't going to name names, but there's been some reports that the United Arab Emirates is among some of the first nations to take seriously these words from the United States to cut off all business interactions with Iran. Is UAE leading the way in this respect?
I would think that the actions that they took last week were not coincident, but likely causal. And I would expect that we would see a broad array of countries taking similar actions as we continue our engagement. The UAE have been very good partners and have taken the brunt of the Iranian attacks in the Gulf. And what have these countries gotten over the years from appeasing Iran? They were subject to violent attacks. While we were bombing Iran, they were bombing them. So it shows that with this regime, appeasement does not work. And on the other side, with this regime, trying to buy appeasement will no longer work in the eyes of the United States of America. And I want to emphasize that we are spreading out across the world as we speak, that you will see a wave of sanctions when you leave this meeting today, and you should expect that cadence to continue. And I would expect that you will see a major announcement of a financial institution being sanctioned by the end of this week. So, Samira from Sky. Yep. No. No. Are you? No. I'm looking for Samira from Sky. No. Hi.
Does the United States and President Trump still want Canada to become a state? He did say that they're getting all the benefits of being a state without being one.
I think he would like Canada to come to the table and negotiate in good faith. They were offered quite a good deal last week. They chose to reject it. Unfortunately, Prime Minister Carney rose to power on an anti-American, anti-Trump platform. I believe he was more than 20 points behind, and he seems to have gone back to his old playbook. And I think one has to ask oneself, is he trying to benefit himself, the Liberal Party, or the Canadian people? Because they were offered a very good job. So, yep, you.
Thank you, Secretary Bessent. If I could shift to bond yields quickly. We saw them tick down today after some turbulence and going up last week. Can you tell us if there's any possibility that there will be more bond buybacks anytime soon?
Again, we haven't bought a single bond yet. The next time we have an operation is September 9th. So we will see on September 9th. All right. One more. Let's see. You in the front.
You described this as an economic D-Day, but D-Day wasn't a threat of an invasion, and the U.S. didn't give a timeline to Germany. So why not impose the sanctions today?
Well, we are giving everyone the opportunity to remedy bad behavior. Why would I want to blow up the global financial system? We believe that it is important to level set and give people a cure period, but they should know that that will move very quickly and that we are serious. Secondary sanctions are a very powerful tool, and we here at Treasury, this is Gene Lang, the Acting Undersecretary for Terrorism Finance, and in the Terrorism Finance Department and at OFAC, The reason we are able to use secondary sanctions is because we do not take their use lightly. So we believe that a warning shot and a level set of expectations is appropriate. And if people do not want to meet our expectations, then we expect, and they should expect, that they will leave the dollar system. Okay, thank you all.
All right, that was U.S. Treasury Secretary Scott Bessent at a press conference around Iran, saying that as of right now, the United States is launching what they call Operation Economic Outcast, saying the U.S. will lay economic sanctions against Iran and any country enabling it. The idea to close economic outlets for Iran. The secretary saying beginning today, the actions of Treasury and other agencies will, quote, tighten the noose that helps fund the Iranian Republican Guard and the country of Iran. Bessent calling it a, quote, zero leakage approach. Now, he added that right now, today, President Trump making calls to world leaders to convince them to cease activity with Iran, and that those countries that tether themselves to Iran should prepare to, quote, share in the isolation of that nation and be tossed off the U.S. dollar systems. Treasury Secretary Bessent noting that new sanctions will go after Iran's links to digital assets, technology, gold, aviation, and shipping. Obviously, shipping, that last part, directly tied to going after oil revenue. And Bessent highlighting that any regime that helps Iran, again, will stand alone and will have a defined timeline to shut down the activities as seen as helping Iran. However, he did not provide strict details on countries, companies, or any timeline that has been provided. Also, what sanctions the U.S. Treasury is prepared to issue against Chinese banks or shipping. The Treasury Secretary did not answer directly, but he did later on in the press conference say that he would expect a, quote, major announcement about actions taken against a financial firm by the end of the week. He was, at the very end, you heard, asked about the possibility of more bond buybacks, but the Treasury Secretary kind of correcting the reporter, saying we have not bought a single bond yet, and that the next Treasury bond operation is set for September 9th. Eamon Javers was in the room. He is now available. I think we have Steve Leisman still. We've got Peter Bookvar here on set with us as well. Eamon, I tried to provide a summary as much as I could. It was a little bit maybe shorter than we thought it would be. What was your takeaway?
Yeah, I think that's right, Brian, and you did a terrific job of summing it all up. I think the two most important words in this press conference were from the Treasury Secretary, warning shots. I mean, this is a Treasury Secretary who's putting the world on notice, but who is not taking direct action right now on these secondary sanctions. What he said is he doesn't want to disrupt the global financial system, and so they're going to give countries an opportunity to get right with the law on sanctions here before taking that action. I think a lot of people coming into this press conference this morning thought maybe we would see that action happening today. And so there might be a little bit of relief in capitals around the world that that is actually not happening. And what you're seeing is this warning shot from the Treasury Secretary saying, hey, look, we expect that countries around the world are going to get right on this. And what the Treasury Secretary didn't say, though, is what specific steps for what specific countries the United States is prepared to take. So he said that those countries would be cut off from the dollar global financial system, but he didn't say specifically on any country, and he was pressed a couple of times on China. The press release that they put out just at the top of this press conference says the teams from the Departments of Treasury, State, and War are engaging counterparts around the world to make clear that the United States expects immediate action. And then it gets a little vague here. It says every country will be given a defined timeline to shut down the Iran-related activity we have identified. Treasury Secretary saying in this press conference he's not going to get into those timelines. He's not going to provide country by country. And so, of course, the big question is what kind of a timeline are they going to give China? And then they also say here, if those countries fail to act, Treasury will act. But we don't get a very clear picture here of exactly what Treasury is prepared to do, especially against something the size and scale of the Chinese economy. The Treasury Secretary very insistent here that these measures do apply to China. He was pressed on that a couple of times and said that all countries need to get right on this, but not really clear what exactly the Treasury is prepared to do in terms of sanctions here on a country as large and economically significant as China, especially as we're now just a month out from that expected Xi Jinping visit to Washington, D.C. in September, Brian.
Yeah, we're going to get more with China in just a second. I believe we're getting Eunice Yoon ready live in Beijing. I know it's very late late, or I should say early in the morning, I think there. The market, maybe, Eamon, breathing a sigh of relief, for lack of a better term. Oil is still down. It was down going into it. Oil's down about 2.5% to $90.52 on Brent crude, 84.83 here. 10-year yields still down just a touch, about three basis points. So the market is not moving in a big way, Eamon, and I wonder if that's because we are still waiting on more specifics. What countries, what exact sanctions, and I think more importantly, maybe what timelines, as you referred to.
Yeah, I think that's right, Brian. The market's not moving in a significant way here because the Treasury has not done anything significant. Markets don't move on warning shots, right? And this is a warning shot. You heard it from the Treasury Secretary himself saying, we're prepared to act if. But markets are not going to move on we're prepared to act if. The other piece of this press release that came out from Treasury, they physically handed it to us just before the presser began, is a long list of entities that are being designated by the Treasury. This represents the U.S. intelligence community and Treasury's very detailed effort to go after all of the specific entities, including specific companies, specific vessels in that gray fleet around the world that are transshipping oil illegally. This represents the Treasury's intelligence product saying we know that these entities are involved in this trade and we are designating these. The trick is for people who are used to looking at these is this is not dramatically different from the list of designated entities that the Treasury puts out periodically in terms of the countries that the entities that they've spotted engaging this kind of activity. So for a lot of people who are used to looking at OFAC designation lists, this list that they put out today will feel kind of familiar, kind of a kind with what the Treasury has done in the past to designate entities that are involved in Iranian economic activities. So I think the question from the market's perspective is, when will that hammer drop, and will we get to a point where we're beyond just a warning shot and into Treasury taking significant and dramatic action in terms of secondary sanctions against some of the big economies in the world? That didn't happen today, and I think that explains the market reaction, Brian.
Yeah, and the market reaction is the same market reaction as it was before the presser began. Eamon Javers in the room where it happened. Eamon, thank you very much. Let's welcome in a bunch of guests. We got Kevin Book, head of research at Clearview Energy Partners. We've also got Jonathan Panikoff, director of the Snowcroft Middle East Security Initiative at the Atlantic Council. Obviously, Kevin and Jonathan, welcome. I'm going to put you both on the spot, Kevin, because we don't know. We didn't get the hard details. There were a bunch of sanctions put by Treasury and OFAC, which is the Office of Foreign Asset Control, on Iran prior to the signing of that memorandum of understanding, kind of that peace deal, for lack of a better term, we talked about. Now that's over. Do you have any idea what these new sanctions may be, Kevin, and whether they will be stricter than perhaps what we saw before the MOU was signed?
Brian, good to see you. There are two sides to the story. One side is how far do the sanctions reach in terms of their scope? And I think as we are talking right now, the Office of Foreign Assets Control has released a new set of, I think, activities and industries that are targeted by sanctions, secondary sanctions. The second side is the enforcement. How far will we go in actually executing enforcement? The Secretary mentioned cutting banks and entities off from U.S. dollar transactions. You think about what sorts of banks, central banks, large commercial and industrial banks, that could be a very, very big step. So we are getting some clarity, but I think that the most important thing is what Eamon said. This was a warning shot. It's an opportunity for the U.S. to have what the Secretary referred to last week and again today as quiet conversations with some of the most significant commercial counterparties that Iran has, including China.
Yes, in fact, Kevin, as you say it, Jonathan, as Kevin says it, I am looking on OFAC. That is, again, sort of the international enforcer, if you will, for the Treasury. There are some new guidelines that were just put out. I can't look at the camera and read them at the same time. I will say something that is interesting to me is that there are new sanctions on Iran levied, Jonathan, but they also, the U.S. Treasury today, I believe, removed Syria as a designated state sponsor of terrorism. That is the title of the release is removal of Syria's designation as a state sponsor of terrorism and associated sanctions list, Iran-related designation. Why I think this is interesting is not about Syria as much as it is about oil. because some of these new pipelines that we have talked about coming from northern Iraq would have to go, Jonathan, through Syria to get to the coast. And I wonder, maybe I'm off, if this removal of Syria has something to do with further plans to get some of that oil away from the Strait of Hormuz. Your thoughts?
Yeah, I think that's absolutely right, and great to be with you both. Look, I think it's worth remembering that before the war started, we were in a place where there was a lot of discussion about whether or not you'd eventually have diversified supply chains, but nobody was really as intense about it. And now you're seeing that intensity change. And so I think you're seeing something happen simultaneously, which is on the one hand, the U.S. is really pushing Gulf states to frankly go back to almost where we were a decade ago on a maximum pressure-like campaign, but saying, by the way, we're going to help you. There's going to be an alternative route. We're going to try to work with you. You're going to need to go up Kuwait, obviously Iraq, Saudi Arabia, all in terms of looking at another pathway out for hydrocarbons that obviously exists through Iraq into Syria. And so I think that absolutely comes into play here as a possible, we're going to have a carrot and a stick. And that's being shown right now today, I think, as part of this.
Yeah, I mean, maybe I'm taking it a bit too far here, Kevin. I'm just surprised that you've got the Syria announcement and the Iran sanctions in the same OFAC release. Again, you know a lot more about this than I do. Would you agree with that thesis? The idea here is to weaken Iran. We know that. How do you weaken Iran? You weaken Iran by weakening its sort of effective, and I'm using air quotes, control over the Strait of Hormuz. And you do that in part by taking out other ways to get oil out of the region.
No, Brian, I do think you're onto something. The administration has said that repeatedly, that they're looking at ways to diminish the strategic value of the Strait of Hormuz as a choke point. Now, that doesn't happen overnight, but what I think we gathered today from the Secretary's remarks is that this is going to be a long process. And I think there's another dimension probably to consider as well. As the economic pressure mounts, there are likely to be reprisals from Iran. And even if the U.S. has continued to sort of pursue the economic rather than the kinetic engagement as a way of advancing their goals, there's no reason to think that Iran will. In fact, quite the opposite. The Secretary of the Supreme National Security Council, Mohsen Rezaei, said that Iran, and I'll quote here, will regard any country's participation in or support for America's economic war against the Iranian people as an act of war. And so I think that, you know, when you're looking at these infrastructure alternatives to the Strait of Hormuz, they are themselves vulnerable to strikes, and they are not in that respect a perfect solution.
Yeah, they're not. And drones can hit pipelines as well as drones can hit ships. I would say, by the way, again, I'm sort of rolling with this. This would be good news, I think, for a Chevron and for a BP, which are combining to sort of build out some of the assets that are in those Middle East, as well as other companies, ConocoPhillips, for example, that might be looking to build some pipelines that would avoid Hormuz and kind of go out. Jonathan, were you hoping for more firm details about economic sanctions and penalties against Iran? We didn't get a lot on timelines or specific entities.
I was, but I don't think it should be that surprising. We've seen this happen quite often throughout the Trump administration on a variety of issues of a lot of conjecture and talk and posts on Trump's Truth Social, or in this case, Secretary Bessent's op-ed in the Financial Times. And then when it comes down to it, there's a little bit of a backing off. That doesn't mean that this won't come to a more greater fruition ultimately. It could. Look, it's worth remembering that, yes, I think this did have an impact, for instance, on the Emiratis last week. I think we saw Secretary Bessent refer to that and the decision they made in terms of cutting financial ties. I think there'll be other countries that there are calls being made behind the scenes and that it could have an impact. Turkey is top of mind for me. In the region, for instance. There is also a challenge here. Look, it's worth remembering that among the GCC states, every single one, aside from Kuwait, has its currency pegged to the dollar. So there is a real challenge for them. At the same time, we're seeing a number of these Middle East states, frankly, go the other way. The Saudis really right now are looking for rapprochement and détente with Iran. And how you balance those two things, I think, is going to actually create greater tensions in the coming months. And so will the U.S. go forward with some of the secondary sanctions anyways, or will it back off? I think that's all still yet to be seen, frankly.
What also is yet to be seen, Kevin Book, is the ultimate impact on the price of oil. And this is where you come in because you're as good as anybody in the world on this topic. Two ways that I could see this. Number one, if you cut Iran's oil exports out of the global market, you take out 1 to 2 million barrels per day, whatever the number is, you raise the price of oil, raise the price of gasoline, bad for election and re-election hopes. However, if you force Iran to sell the same amount of oil, sort of, I use the term illegally, they would disagree with that, obviously, but you know what I mean, sort of on the dark market, you've got to offer discounts to buy that Iranian oil. You reduce its value, you keep roughly the same amount of oil on the global market, but they're selling now at a discount, which could then theoretically lower the price of oil. By the way, the price of oil is down about 2% right now. I just gave both scenarios because that's what I like to do. That way I'm never wrong. How do you see it?
A very gifted analyst you are, Brian. So the secretary last week said something kind of interesting on this network, on Squawk on the Street. He said that it's surprising that the price is going up because our economic engagement means that we're not going to kinetically escalate. It should be coming down. And I think the hoped-for result, the politically hoped-for result from the administration would be to avoid those sorts of acute declines in availability of oil to the global market. But where we are right now is that the blockade is constraining a lot of Iran's exports. So I suppose what you're proposing is something like the price cap architecture, where sanctions-distressed barrels clear at a lower price realized by Iran, but don't actually deprive the world of volumes that are currently short. That is in some way maybe still happening a little bit. I think there are news reports that some of the off-takers who are taking other barrels out of the Gulf are taking them at a discount, and it's probably the case that Iranian barrels are clearing at a discount too. But if we were to eliminate the last of the Iranian barrels, we're assuming the blockade stopping a lot of them, Brian. We're probably talking about $2 to $7 a barrel for the residual volumes that are going out right now. And it's really the escalation in response that could be a bigger upside risk to the price.
And in the next hour in Power Lunch, I'm kind of going to do something, Kevin, where I'm going to show why the numbers around Hormuz seem to be all over the map. You've got the U.S. government saying one thing, Iran, which I don't believe, by the way, in any case, but Iran is saying something totally different. We'll get to more on that. I'd love to get your take on that in the next hour. But Jonathan, quickly to you, we heard a lot about currencies. I'm not a currency expert by any means, but do you believe maybe the ultimate goal of Secretary Bessent and Treasury is to crash the Iranian currency? It's not a liquid market, so it's hard for us to just bring up a chart and look at it. It has been going down, and when you do that, you damage economies. Do you think that is kind of a quiet or not so quiet goal?
Look, the reality, you're right, is at the weakest point it's been, frankly, since the revolution. I think the goal is to strangle the economy as a whole. I think where I'm slightly a little more skeptical is the process that would take to really then engender the type of protests, the type of significant street demonstrations throughout the country, not only in Tehran, that could meaningfully threaten the regime. It's probably not a months-long process. It's a years-long process. And so are we going to have the consistency of this type of campaign, not only through the end of this administration, but into the next one? Because that's probably what it's going to take.
Yeah, just so much here. We didn't get on the firm detail side, but I think when you read between the lines, you look at Syria, you look at some of the currency moves, and you look at some of these other countries, I think it's pretty easy to put that together. It's easy because we have smart people like you, Kevin Book and Jonathan Panikoff, here to help us do it. Thank you guys both very much. All right, coming up, folks, it is not just sanctions today. Treasury Secretary Bessent's bond buying plan also getting attention. We'll talk more about that with Peter Boockvar. He's been very patient, by the way. We've also got Eunice Yoon inside of China and how maybe that country is trying to play peacemaker with Iran, but also keep the United States happy ahead of President Trump and President Xi's meeting next month. There is still a lot more to do. The Exchange and CNBC back right after this. All right, let's continue our coverage of the Treasury Secretary's announcement against major sanctions against Iran. Joining us now, Eunice Yoon, who's live in Beijing. And Eunice, I know that you've got a lot more on next month's meeting between President Trump and President Xi, but I just kind of want to pick your big brain. We heard a lot of veiled references to countries helping or enabling Iran. Obviously, it's not a huge stretch to know that China is indirectly referenced. What do you think is the delicate dance, if you will, for Beijing between relationships with Iran and also with the United States?
Well, I think with the Trump administration is in a really difficult position. Their dilemma is that if they do want to isolate Iran, then they are going to have to get tough on China. And it's very unclear just how much of a stomach the White House has for that. As you had mentioned, we are very carefully watching President Xi's upcoming trip to the White House, or at least to the U.S. From China's perspective. Just in a matter of weeks, President Trump is expected to host him at the White House. And so far, the Chinese have indicated that any such action, such as a sanction, would be destabilizing to this relationship. Today, the Foreign Ministry had said that they would vow to safeguard what they described as their legitimate rights and their interests when it comes to like any potential problem that the U.S. would cause for them. And of course, the biggest card for the Chinese is the rare earth restrictions. And as part of the discussions in the run-up to the Trump-Xi meeting, there's been a lot of expectations that both sides have been working towards a renewal of those restrictions being eased, so that you would have this truce, you would be allowed to have rare earths flowing to the United States. So that's a big problem. Another, I think that you should worry about, or that one should worry about, is that the Chinese are not expected to make it easy for the Trump administration. It was only a matter of months ago where the U.S. had indicated that it would potentially threaten sanctions on this kind of shadowy network of Chinese, what they're called these teapot refiners. So they're smaller refiners that they work with the Iranians. They're integral to Iranian oil coming to this country. And the U.S. threatened to impose sanctions. And the Chinese actually reacted by telling the Chinese companies to ignore the United States, to not comply with anything that the U.S. says, because if they did so, they would be breaching Chinese law. So the Chinese are not going to likely make it very easy for the U.S. to be able to impose their will on Chinese companies.
Eunice Yoon live in Beijing. Eunice, I would say good evening, but it's actually early in the morning there, so we appreciate you being up for us, as always. Thank you very much. All right, let's bring in a couple more voices into this. We've got Peter Boockvar, who's been on set for about 45 minutes, being very patient. Steve Leisman also joining us. Steve, I'm going to go back to you. Sorry to cut you off right at the top. You understand how this game works. Were we hoping to get a little more detail on that Treasury buyback program, which the Secretary sort of, said, listen, we haven't bought anything yet because the next official operation is September 9th?
Yeah, I mean, my colleagues in the press there had other things to ask the Secretary about. I would have loved to have had another question about it. But my sources are telling me that one of the things under consideration is to fund these buybacks using a piece or part of the TGA, $1 trillion sort of rainy day savings account. Mostly there, the cash comes in and out. We pay Social Security and refund the bonds through there and everything. But it's also there for things like when there are debt ceiling impasses, and we fund the government that way. And they look, Secretary Bessent was on our air last week. He told Sarah, I have a big toolkit. Well, this is just one of the things in his toolkit. They could fund it with short-term bonds. That's still out there, short-term bills. That's still an option for them. They're not saying they won't do that, but they're saying to the question that was out there and the criticism, Brian, that was out there, that the Treasury doesn't have a big enough bazooka to play this game. Well, Bessent and the Treasury are suggesting that. Maybe we do.
Yeah, Peter Boockvar, I would argue the Treasury doesn't just have a bigger bazooka, it has all the bazookas because it has a money printing press. There's no sign they're going to do that. But they have the ability, and we talked about this TGA Treasury General Account that could sell some of that, buy back bonds. How big do you think the Treasury's toolkit is?
Well, the ultimate toolkit needs help from the Fed. They're the ones technically that has that printing press. So I do think he's rather limited in terms of the amount of short-term bonds he's going to sell to finance it and how much he wants to draw down the TGA. Because if he draws down the TGA, let's call it even big, $500 billion, yeah, maybe that's the right level. But once that bond buying is done, what does the 10-year Treasury do? The Fed had the same experience. After QE1, 2 weeks after the Fed was done, the impact wore off. QE2, in fact, the Fed was buying long-term treasuries under QE1, and yields went higher instead of lower. QE2, they bought bonds to suppress yields. They actually went higher. So just because he's buying doesn't mean it's going to work. And it's also a game of whack-a-mole, because what happens to the U.S. dollar? What happens if inflation flares and Kevin Warsh needs to hike rates at the same time the Treasury Secretary is front-loading T-bill issuance? So there is not one clear flow-through here to what he's doing. And if it doesn't work, like FX intervention never works, then what does he do then?
Steve Leishman, I think it was 2023, so 3 years ago, I think, correct me if I'm wrong, yields on the 10-year went from 4 to 5% pretty rapidly, and the Treasury stepped in. That was the previous administration, and did a version of this, correct?
Yeah, and I think Peter got an interesting point of view here. I'm not sure we've actually defined what the Treasury operation is here. According to my reporting, what the Treasury is talking about is buying off-the-run bonds to help smooth a transition or help close some of the gap that's out there with very wide spreads with off-the-run bonds. My reporting does not indicate, it may well be that the Treasury Secretary wants to control the 10-year or the 30-year. But this is not about that. This is effectively a very fancy accounting thing. The Treasury is typically not creating money here. The Fed can create money. One of the things that's sort of good about this story I've reported is it takes pressure off of the Fed. It allows the Treasury to use some of its money over here to put it over there. It's already taxes collected, and they'll buy down the U.S. debt a little bit on the off the runs of the buybacks. I just think, Peter, it's not quite the operation at this point that people are making it out to be. Yes, he'd like to have a positive impact, perhaps slow the increase of bonds, but he's not picking a line in the sand here that the 10-year shall not pass 470, to quote Gandalf.
Well, Steve, I think the initial ammunition he brought to the table, I agree, but it's clear to me he did draw a line in the sand. He picked about 475 in the 10-year as something that he wanted to press up against. And if you're going to do that against a market that is as big as the Treasury market, and I want to add, it's not just the Treasury market he's pushing up against. It's the JGB market he's also pushing up against.
Japanese government bonds.
Exactly, because what happens in Japan and their bond market and what the BOJ does not stay in Japan. It flows into the U.S. Treasury market. So it's actually two markets, I would argue, that he's pushing up against.
You know what, Peter? I didn't hear the 475 thing, but I'll just say this. I'm pretty sure Scott Bessent's pretty clever. And if he was going to go to war with the $32 trillion bond market, he wouldn't go there with a squirt gun or a knife. He would go there with a bazooka. And this trillion-dollar TGA is not a bazooka for fighting the bond market. It's a tool to potentially use to smooth out rates and otherwise close the gap on the off-the-runs. If you were at 475, Peter, you're a market participant. I can't take that away from you, what you heard. That's not what I'm hearing.
So I love the Lord of the Rings reference, by the way, Stephen. I did catch that. You shall not pass.
Thank you.
Okay, quoting Gandalf. But what are we not passing? 475 or 5? Is 5 the proverbial sort of Treasury market line in the sand?
I don't think Bessent's playing that game. I'll give Peter his due. He's about one of the cleverest guys out there on the street. I don't think the Treasury Secretary is drawing a line in the sand. I think he's smoothing over liquidity, and he's putting the bond market on notice here that he has a bigger toolkit than they gave him credit for the first time. He's not just going to sell Treasury bills in order to finance it. He's got this other thing over there. If he takes $100 billion out of it, it brings the TGA down from 950 to 850. No one really cares about that, but it's not creating money, and he's not fighting the bond market. I think he wants to smooth the bond market where it wants to go.
All right, quickly, Steve, like Kevin Warsh's first big policy speech ever is going to be this Wednesday, I think Wednesday or this week in Jackson Hole. You'll be there. Friday, what can we expect? What's he going to say?
Our coverage starts Wednesday. Warsh speaks on Friday. I think he's going to give us a little bit more than we've had before. I don't think he thinks he can get away with what happened the last time, which is not saying anything. Bond market wants to hear more. It will hear more, I believe. But he won't go as far as other chairmen have gone, but I think he's going to say that, listen, I gave one kind of information, a set of information coming after the FOMC meeting. I speak for the committee there. Here, I speak for myself.
All right. Well, you spoke for yourself. Well said. Steve Leisman, thank you very much. Peter Boockvar, thank you, and thank you for your patience. Everybody's kind of rolling with it as we get the live press conference, and it's a rip up the scripts kind of day. All right, coming up. Oil is down about 2.5%. This after Treasury Secretary Scott Bessent announced new Iran sanctions. Your trader has been bullish on energy for a while now. We'll see if that changes based on what she heard today. That is next on The Exchange and CNBC. All right, welcome back to CNBC and The Exchange. Kelly is off today. Oil is down right now, about just over 2%. Crude oil below $85 a barrel. But as you may know, your next trader has been finding opportunities in energy for years. Joining us, Victoria Green, G-Squared Private Wealth CIO, also a CNBC contributor. You've been early and you've been right on many of these big oil calls. Anything that you heard today from the Treasury Secretary, Iran, et cetera, that changes your bullish view on some of these oil stocks?
No, I mean, I think it's going to be very geographically diverse because on one hand, you had what Bessent said, which I believe is going to target both Turkey and China, maybe somebody like Indonesia and Malaysia. On the other, you also had Mark Carney speaking at the same time, a Canadian PM, which would put a lot of like Midwest refiners and potential Northeast energy at risk. So you have these two conflicting macroeconomic events. I think I'm staying put, man. I love my refiners right now. We're making record margin. That's the bottleneck right now. The bottleneck, honestly, isn't crude. The bottleneck is refinery. We've got about 7 to 10% offline right now.
Yeah, and by the way, excellent point about Canada. I mean, Canada is a far larger and far more important oil partner to the United States than Iran is or will ever be. We love our Canadian friends, and we love their oil as well, by the way, because otherwise you're going to $7 perhaps a gallon in parts of California and Seattle. Listen, these refining margins have been monstrous. I mean, but then at some point you got to lap them. You know, every quarter it gets a little tighter and harder to sort of make those comparisons, Victoria.
It is, but it's where the profit's being made. It's pretty clean profit. We do think refining margins are very, very high right now. Also, capacity is stretched. Shell was at 102% utilization. We're at 97, 98% across the Gulf Coast. I do think refiners are a benefit here. If you're looking for a hedge on Iran, if you're looking for a hedge on oil prices going up, I see refiners as a great pure play, especially some of those large Gulf refiners like Marathon or Valero. You know, if you avoid like a PSX or BP that has a little bit of Midwest exposure, which would be more exposed to Canada, a lot of those guys pipe in about 100% of their heavy crude from Canada. I think you just have to be very aware of where your oil's coming from and what your exposures are geographically.
You got a hot take on some of the smaller ones, the PBFs, by the way, New Jersey-based refiner. Who knew New Jersey had refiners? PBF, a Par Pacific, a Delek. You care about any of those?
I think the small guys are great because they're going to catch the overflow, right? With Russia offline, with Iran now bottlenecked, you have so much need for refining. All these small guys can snap up some contracts, maybe have better margins than they ever had. I think if you got a good refinery play, you want to hedge against oil prices spiking, that's the best place to be in the oil and gas space right now.
All right, Victoria Green, G Squared Private Wealth. Victoria, thank you very much. Do appreciate that, folks. That's it for the exchange here. I'm going to see you in a couple of minutes on the other side of the break with Contessa Brewer and Power Lunch. More on Bessent, more on oil, more on those real numbers around the Strait of Hormuz. See you in 2 minutes.
Alrighty, traders. It is I, Abdul Shabazz. Well, just to give you a recap, I haven't taken any trades today. The market has yet to hit my area of interest. I came to you guys this morning letting you know what my game plan was, where I wanted to take a put was at the 7062 area and below. Where I wanted to take a call was breaking at 767 area and above. I wanted to stay out of this mix right here. I want to stay out of this mix right here. Hold on. Now, Brother Ali, let me call you back. I'm on the air right now. Okay. Now, so I want to stay out of this area right here, this chop zone. Okay. I want to take a call if we break above it. I want to take a put if we break below it. Coinciding with the plans that I had today. Take a call at the 768 call and above. I could probably move that down to 767.
Treasury's
take a
warning
put
shot to Iran. It's called economic
at the
outcast.
762 area
and
below.
Is off all this week. Treasury Secretary Scott Bessent unveiled
the 762 area and below. So these were my plans coming into today. Align those plans up with these alarms. I got an alarm here at the 767 and another alarm here below at the 762. Right now we have a control selling algo, and it looks like we're getting ready to break that algo. And that could be good for the bulls because they are showing, you know, real support here at that 762. Let me go ahead and blow it up here so you can see exactly what I mean. Blow it up here on a 5-minute chart. You can see we came down to that 762 twice already today, and in doing so the bulls found support. The second time we actually put in a lower high right at my alarm, came right down to my alarm, knowing what could happen underneath it, bounced away from it, which is fine. I have no problem waiting, making money with other things as I wait for my trade. I'm not going to force anything. Every day is not going to be a trading day, and that's okay. I clearly know the areas that I want to trade. We haven't gotten to those areas, so I and you will remain patient. Okay? It just is what it is. The market is building liquidity that we will be able to use probably for the rest of the week. But more importantly, we're not taking any frivolous, unnecessary trades. It's professional trading that is being done here, and I want to thank and support and commend you all for doing so. Big shout out to those of you who watch the replay. I know that a lot of you all don't have the ability to tune in live, but I do thank you for your end of day viewership, as it does help me tremendously. Alrighty, thank you guys so much. I'm back in the background. Team, I'm going to give this about 30 more minutes. If I don't like what I see in 30 more minutes, I'm going to go ahead and shut down the live for today. And thank you all for your attendance.
If he's forced to. And so the question here is, what is this message coming out of Washington today? How is that being received in capitals around the world, particularly capitals like Beijing in particular, where leaders sent a message last night saying that they're concerned about this U.S. action and they're worried about too much economic pressure on them. So some really open questions here, guys, I think, in terms of how this will be received and when it'll happen, if it happens at all.
It's true. All right, Eamon, thank you for that.
All right, one big question still remains. Can Washington turn up the pressure on Tehran without also turning up oil prices? Let's bring in sanctions expert Daniel Tannenbaum. He's a partner at Oliver Wyman. Dan, appreciate you joining us. Listen, you're a sanctions expert. You know so much about this. We had sanctions on Iran. Many of those were either done away with or sort of suspended when we got that memorandum of understanding a couple of weeks ago, sort of that peace deal, if you will. That ended. I assume these sanctions are back on, as well as some new sanctions. What do we know? What are we still waiting to learn right now?
Brian, it feels a little like when your kid misbehaves and you're going to count to 3. I mean, that feels a little like where we're at the moment. The sanctions were never lifted. They were going to be not enforced.
Yeah, kind of suspended, right? Don't do it again, exactly. And we're gonna give you the benefit of the doubt under that memorandum of understanding.
Exactly, but let's be clear. I mean, there is nothing new in what was announced today. That pressure that we're talking about, that Secretary Bessent's talking about, has been on the table through secondary sanctions for years. Now the question is, it's time to act. I mean, and China is the real linchpin here. They buy 80% of Iran's oil. If President Trump has the relationship he claims to have with President Xi, he should really be making a deal with China to try and offset their purchases of Iranian crude, because that is what's helping to continue to finance Iran right now.
To your point, the sanctions existed before this current presidential administration. Also, to your point, it didn't really do much to dissuade buyers, mostly China, maybe some India thrown in there and other countries, from buying Iranian oil. Iran just kind of had to do it in a more surreptitious sales type way. Is there any level of sanction, Dan, that you think that would accurately, or I guess forcefully, prevent Iran from selling oil that would also not spike the price of oil?
If the U.S. sanctioned a non-state-owned Chinese bank, assuming one was involved in oil or other trade with Iran, that would be a wake-up call. And I think Secretary Bessent alluded in his remarks.
He said by the end of this week, but he said something, I'm a paraphrase, by the end of this week, I wouldn't be surprised to get some kind of major sanction on a major financial firm. I mean, he kind of alluded to it without saying.
He did, but let's see it. The U.S. government has been extremely reluctant to go hard on economic sanctions, not export control, but economic sanctions on China. I say this having worked on these issues for 22 years. I mean, there's been a number of investigations in Democrat and Republican administrations of Chinese state-owned banks and non-state-owned banks that have violated American sanctions that have never been brought to bear. It's time to actually execute against these if we're serious about trying to curb Iran's financial connections.
All right, you're talking about how and why sanctions can work. But Eamon brought up that the Treasury Secretary said in response to, okay, well, this is, if you're comparing this to D-Day, D-Day was a surprise. Why aren't you surprising all of these organizations and countries with sanctions today? And he said, why would I want to blow up the global economic system? His understanding is that if they put into place all of the sanctions they are prepared to do, that there will be economic mayhem. Do you agree with that?
I totally agree with that. And that reluctance is good on one hand, but there's ways to calibrate what would be a meaningful sanctions package, a designation that would show that the U.S. is serious while not totally screwing the global economy. There are ways to do that. And so giving this time, I mean, look, the president pushed this issue of de-risking from Iran back in February when this began. I mean, countries have had ample time to really reevaluate here. It's time to actually put something in place that shows how serious we are. The 60 designations that came out today were really not that impactful, and they banned remittances and cultural and academic programs. They went at the humans in Iran, not the government. So, like, that isn't going to fix this conflict.
Yeah. So one more. You're focused on China. Are there any other players that are supporting Iran right now that become meaningful to the U.S. economy or to the global economy?
You've got the Emiratis, which the UAE did announce that they were suspending business with Iran, but that's not something that'll happen overnight. Iraq is obviously a unique situation now, have Iranian businesses operating there. There's a nice relationship now between the new PM and President Trump. Turkey, India, there are other countries here that are in the mix and continue to trade with Iran and trade with the U.S. and haven't heeded those warnings. But China is really the big one out of all of them.
All right, so Dan, we'll continue and wait, I guess, when we hear the government name names. Dan Tannenbaum, who's the expert on sanctions, appreciate your sharing your wisdom and your expertise with us. All right, the other big Treasury story that we're following today, two senior officials tell CNBC the department could tap its $1 trillion general account to help fund purchases of government bonds, those buybacks. Treasury Secretary Scott Bessent had built that cash pile to about $950 billion. The news comes after the Treasury surprised markets last week, doubling the size of its bond buybacks. And in fact, the Treasury Secretary was asked about it in the news conference right now, and he said, well, we haven't started yet. Joining us now, Tobin Marcus, head of policy and political strategy at Wolfe Research. Okay, what's the implication if Treasury goes to the general account and starts using that to fund bond buybacks?
Thanks for having me. So this doesn't really change my expectations for that program. When we were writing about how it could look last week based on the initial rollout and based on Treasury Secretary Bessent's comments on this network on Thursday morning, we were clear there is a lot of firepower here if they're willing to use it. You know, even if it were funded by new bill issuance, there's a huge ability to increase how much bills they're issuing to ramp up the buyback program. There's nothing stopping them from, issuing hundreds of billions of dollars in new bills over the course of the next, several months to fund a big buyback program. So, tapping the TGA it shows perhaps some more concrete planning around this, but I don't think it changes my expectations for the potential scale of the program. And it would need to get quite big, I think, to have a meaningful impact.
We're seeing the yields retreat just a little bit on the news about this potential for the buyback. At what point, if Treasury continues down the path, does this start to look like easing and conflict with what the Fed is doing?
Yeah, I think it already, in terms of intention, is clearly pushing in that direction. It's very hard to read this entire thing as anything other than an effort to bring down yields and ease financial conditions, just based on the way it was rolled out ad hoc several weeks after they had formalized their normal buyback program in the QRA in early August. So that's clearly what it's intended for. I do think that runs somewhat at cross purposes to Fed policy, where they're debating whether or not they need to tighten. Our expectation is they'll probably remain on hold, but they may need to tighten at some point, and this sort of is fighting against it. So right now, I think the direct impact of the buyback program just is not very big based on the announced scale. But if they do really intend to ramp it up to hit the evident goal of that program, I think it is rowing somewhat opposite to what the Fed's doing.
Okay, sort of answer your own question, Tobin. Do you think they'll do that? They got the next operation is on September 9th. So let's say they do something, yields don't move down. They do something else, yields don't move down. I mean, they seem to have a pretty big bazooka, to coin the phrase that we used in the previous hour.
I am not really a believer. So first of all, in terms of how big they would need to go to have a big impact, the Treasury twist moniker that Bessent has given this calls back to the Fed's Operation Twist in 2011, which had a similar idea, sort of changing the term structure of outstanding Treasury issuance. That ended up getting to $667 billion over about 15 months. So for Bessent to take, from what's already been announced to get there, you'd need to increase this by a factor of 8 and run it through the end of 2027. So it's quite a big expansion. And the academic literature estimates that the impact of that was about 15 basis points on the 10-year, right? So if you're really trying to bring down the long end, I think you need to do a lot. And even though they do have the capability to go bigger, I'm not sure they're willing to go that big. Bessent also just hasn't really been projecting the kind of whatever it takes resolve that you'd want to see if you were trying to move yields. When he was asked about the buybacks today, as you alluded to, he said, we'll see on September 9th. So both last Thursday and today, he came out, he communicated about this, and he conspicuously declined to say, we're going to do whatever it takes to get yields down. So I'm not really a buyer that it's going to have the impact it's intended to have.
Okay, the market isn't yet, but we'll see if the market does ultimately move because it gets that point of belief. Tobin Marcus of Wolfe Research. Tobin, always appreciate you coming on. Thank you very much. All right, on deck here on Power Lunch, we're going to try to answer the big question in the energy markets right now. How much oil is actually getting out of the Arabian Gulf? Some ideas you may not be thinking about. Plus, the big trade ahead of NVIDIA's earnings in just 2 days' time and your big market setups right now with Ryan Detrick. We've got a lot more to do. We're back right after this.
The S&P has already delivered double-digit gains this year, up about 12%. But does the rally have more room to run? Carson Group thinks yes, projecting the index will finish the year as high as 18% up. Ryan Dietrich, Chief Market Strategist at the Carson Group, joins us now. Nice to see you, Ryan. All right, give me a sense right here. The Dow's holding up today, NASDAQ slightly lower, S&P off just a bit. Did you expect a bigger reaction to what Scott Bessent had to say?
First of all, thanks for having me back, and I hope everyone celebrates National Waffle Day out there today. You think about it, no, I don't think we're overly shocked by that. I mean, today looks like watching paint dry. I know chips are down a little bit more. I mean, as everyone said, NVIDIA earnings coming up, obviously Jackson Hole's coming up. Bottom line, getting a little technical for a second here, as long as we stay above the June 2nd peak, around 76.10 on the S&P 500, I think this is constructive, and we're just kind of catching our breath here.
All right, let's talk a little bit about the big picture here. You're overweight tech, financials, industrial, healthcare. Where are you seeing opportunity?
Well, those areas, I guess, specifically, and you think about it, like the economy, is probably other guests have pointed out. I mean, it looks like it's turning the corner to us. Those regional, surveys we saw last week are strong. We know we just had really good earnings season. I know the consumer, you can pick fits and starts there, but we've said a lot this year. This is an inflationary growth environment, meaning inflation is going to be a little hot. Yields might be a little bit higher, but the Fed's going to run it hot. And again, do we think being equities, overweight equities, underweight bonds still makes sense? We've said if you drop it, hit your foot and it hurts. Those are the things you want to have in that bucket to diversify your bond portfolio. But one of the other concepts we've talked about is kind of a barbelled approach, right? You don't have to be a hero. You don't have to have just all one thing. We're saying, hey, own some growth, own some value. We manage billions of dollars here at Carson Group. We're probably about 53% growth, 47% value. I feel pretty good with that because there's a lot of areas that very well could take the baton, like healthcare just did obviously last week with the incredible moves we saw.
All right, I'm looking at a chart that you sent over here that say, and it appears in your chart, you're not seeing anything overly concerning, even if there was a June peak for the S&P 500.
Mm-hmm. Well, that's correct. And again, we did have a June peak on June 2nd, but we went above that. No year in history has ever peaked in June. So history doesn't repeat itself, often rhymes, Mark Twain. We'll get a little more technical for a second. Just 2 days ago, 74% of all the components in the S&P 500 were above their 200-day moving average. You go back in history, when that's trending higher, that's usually a good sign. Now, eventually, yeah, you might have a peak. We could have some August, September volatility. Everyone knows midterm years. You historically can see that, but I think we kind of had that volatility ahead of time this midterm year, and we're still pretty optimistic we get through this week with Jackson Hole. One more thing on Jackson Hole, don't forget last year Jackson Hole market liked what I heard because the Fed back then said going to run it hot, and what really took off after Jackson Hole, that's when gold really got going. So we're looking at maybe another situation like that where the Fed says, hey, we don't think they're going to cut. I mean, we might be contrarian there. I'm sorry, hike. We don't think they're going to hike. We think they're still going to run it hot. You want to be in equities and maybe some gold and commodities in that situation.
Gold has gotten hot again. Bitcoin was up 22% last week. Bitcoin, it's like the Bengals. It's like they came out of nowhere. All of a sudden, they did. Well, I had to throw that in there, Ryan. I apologize.
Thank you.
Listen, sort of our top story the last few days has been about this bond buying program, not to go back to the top. Do you view, I know you're optimistic, okay, but if the 10-year, and it's a big if, I get it, if the 10-year were to get close or hit 5%, would you change your views?
Yeah, we could. I mean, I think so solely. Again, why are yields going higher? When they were doing this, a year and a half ago, you can make the argument it was because growth was coming. Now the bond market probably sniffs out potentially higher inflation. But you look at that 10-year, it hasn't broken out yet. 470 to 480, that's been the peak going back for a couple years now. I know the long end has broken out. But again, if everybody's thinking alike, somebody isn't thinking. General Patton, my goodness, everybody understands what yields are doing. We see what the Treasury Secretary wants to do. I wouldn't be so quick to say he doesn't have control on this and to say he couldn't push the longer end lower. And one more thing on that. I know a week ago he said, maybe more like an Operation Twist is what we're dealing with. Yeah. But after what they said today they're going to do, it looks like a QE. And QE, it is what it is. Go back in the history books. It tends to suggest that money flushes in, money comes into the economy, and it's probably going to continue to push things higher here. So
as the grandson of somebody in Patton's Third Army, I love the reference. So thank you for that. Very quickly, let's not forget, in 2023, I think that was 3 years ago, Contessa, we saw the yield go from 4 to 5% on the 10-year. It was scary. Treasury stepped in, but guess what? The stock market has gone up and up and up since then. So is there a case to be made that even if we get the 5%, I think to your point, Ryan, it's why we have it, not the absolute number that matters?
Exactly. 2023, I got to come on here a lot solo and had that evening show, and we talked a lot back then about why things still look good. I mean, listen, historically, higher trending yields, it tends to suggest the economy's doing well. The reality, look at the shape of the yield curve. It's steepening. I mean, that one there, again, is more of a positive, probably why financials and banks are doing well. When you have financials and banks leading, messages the market says you probably still want to be a net buyer here to continue bull market.
Hey, Ryan, thanks for joining us on this Monday. Appreciate your time. Well, Jackson Hole, of course, yeah, waffle day. Who's taking advantage of that?
You know, I can't decide how I feel about National Waffle Day. Sometimes I love it, sometimes I don't.
What makes
you see what I just did?
Jackson Hole has a, yeah, I got it.
It was like a Wordle.
Such a dad joke. Jackson Hole has a focus turning to what Fed Chairman Kevin Warsh may say or may not say. Morgan Stanley doesn't expect many new clues on what the Fed will do next. Instead, the bigger conversation may be about how the Fed should keep up with rapid financial innovation. And Stifel says even a dovish tone may not be enough to push long-term yields lower. We have full coverage, of course, from Jackson Hole beginning Wednesday. You won't want to miss that.
All right, coming up, a key question. How much oil is really getting through the Strait of Hormuz? We're going to try to sort through all the conflicting signals and numbers and then talk about it with Matt Smith of Kepler. That's all next. Stick around. It is perhaps the question the entire global oil and energy market is trying to answer right now. Exactly how many ships and how much oil are getting through the Strait of Hormuz? The numbers you hear are probably all over the place, and there is a lot of conflicting information and data coming out on all sides. For example, U.S. Energy Secretary Chris Wright says that last Tuesday, over 15 million barrels of oil and products went through Hormuz. That's not far from a normal pre-war volume of about 20 million barrels. But the Iranian bosses say those numbers are wrong and very little oil is moving through the region. And they or their proxies sometimes cite marine traffic and Kepler satellite data to make their own case. Of course, Iran has billions of dollars of reasons to say anything negative about oil or the American economy, so take it all with some skepticism, because there may be things that are happening which help explain both sides. All right, it's pretty simplistic, but we made this map for you to try to show you a couple of things that we haven't talked a lot about. For example, there are these two islands off the coast of the UAE, the Das Island Marine Terminal and Zirku Island. They are not only loading ports for the UAE, but they can also be moved to move oil from other countries around. Some of this oil may then come through via U.S. naval escort with their radar and transponders off, meaning they're almost invisible for short periods of time. That's not all. The UAE also has this huge port of Fujairah that is on the east coast of its peninsula and facing the Gulf of Oman. Not only is that a big loading port via pipeline, but off the coast, tankers here, just in this region, they can do ship-to-ship oil transfers. The idea is that oil comes in via pipeline, then leaves and gets put onto other ships, which then steam to their respective ports, but never go through the Strait of Hormuz. This is just one part of the case that some would make that more oil may be flowing through than some think, and that camp they're in. We understand, folks. This is all complicated. It is often confusing information, but let's be clear. It's also a complicated and confusing time and region of the world. The bottom line is that the global oil markets are clearly in deficit. 20 million barrels of products, they are not getting through Hormuz, maybe far from it. But the oil market is going to move a lot in either direction. If it believes 15 million barrels per day are getting out, however they're getting out, islands, ship-to-ship, pipeline, whatever, or just 5 million barrels a day getting out, that difference can move markets by billions or tens of billions of markets or dollars per day. Matt Smith of Kepler tracks this for a living and knows as much as anyone and joins us now. Matt, all right, you heard what I had to say. What are you seeing? What are you hearing? What do you think is the real situation around Hormuz right now?
Well, Brian, it's a patchwork quilt to get these numbers together. And what I mean by that is that, and you outlined a number of these different methods, you have some crude and products that will be going through the southern corridor, the Omani route there. You have some that are going through Dhaka and just leaving. There are some that are shuttling through the corridor there. They are then getting to tankers. They're outside in the Gulf of Oman. They are doing ship-to-ship transfers and then leaving from there. So that's a really developing trend in that we could see much higher volumes leaving from there in the coming months, because you're having tankers that are taking the risk to be taking it through the Strait of Hormuz. But then these, in terms of the other patchwork pieces, right, we have still the Iranian route. You are seeing some volumes going through there. It's a good number of tankers. It's a low volume. It's smaller tankers, that type of thing. So you kind of add all that together. And then you have the added dimension in that the satellite imagery is being delayed here. And so once we've managed to track all these pieces, we are then having to look at the imagery and try and reconcile more vessels there. And then there's the other piece, and finally, just in terms of Fujairah there, as you mentioned, you have the pipeline that runs about 2 million barrels a day. That's able to avoid the Strait of Hormuz. And then just the last piece is what goes across on the east-west pipeline across to the Red Sea there to load at Yanbu. Challenge with that is even today we have seen at Yanbu a tanker being struck there by the Houthis. And so this remains a very volatile situation. You can see that in the day-to-day numbers that are coming through. But the key point to bear in mind here, Brian, is that we are not at pre-conflict levels here, and prices are telling us. Prices are the things to watch here. You know, we've had a lot thrown at us over the last few days, and yet WTI is hanging around 85, Brent is well above 90. So watch that price action as much as anything, rather than the minutiae of the day-to-day.
And I want to say that you guys have an impossible job right now, and you and your team at Kepler Marine Traffic are doing a great job. We've been calling attention to the charts. How about this? Is the one thing we can be certain of, Matt, is that prices are up, right? Because if you're doing ship-to-ship transfers, or if I'm putting oil from a ship to a pipeline back to a ship, I know one thing: it's going to be expensive.
That's part of it, Brian, but it's just we're not kind of back to that pre-conflict levels on a consistent basis. And so we are still here now, coming up to the 6 month of being in this conflict, and we don't see barrels flowing freely. That is the problem here. You know, we've got the problem on the product side of things because refinery runs have been down for so long. We can see that coming through in diesel prices, right? They're double what they are for a barrel of oil. It's really just on the WTI, the Brent side of things, where we have been playing catch up as the situation refuses to fully get resolved. And by all means, the US administration is really giving it its best shot here to try and get those volumes out. But the prices are just telling us we're continuing to struggle to get back to normalcy here.
Yeah, so given the price, what's the market betting on? That they're going to find supply somewhere else, that enforcement's going to be weak? What do you think is the reason behind oil being lower, even after these secondary announcements about the asphyxiation of sanctions?
Well, sure. I think the concern, Contessa, about Iran is not really there on the shipping side of things, in that we've got the blockade in place. Iran barrels are already being strangled off of the market, right? They're not getting out. And so they're really struggling to even load in the Mideast Gulf there. So there's that side of things here. But just in terms of the increase in your price, we're into the 6th month here. There has been this expectation. We've been told there's going to be resolution. There's going to be a compromise. There's going to be a ceasefire. There's going to be a new memorandum of understanding, etc. And it just hasn't happened. And so the markets, from an oil perspective, are just continuing to price in these lack of barrels being available, while the product market is particularly
Matt,
diesel.
sorry to jump in. Are you able to track, and I saw Kipler put out data, 74 crossings. Are you able to track, sort of, transponder off crossings or shadow fleet crossings or ships that are escorted by the U.S. Navy? Are those things you can ultimately track, maybe not at the time to the Hormuz, but rather later on when they get to whatever port they're going to?
Well, there's two ways. So one is retrospectively with the satellite imagery, yes. The other piece is that they are going through with the transponder switched off, but then they are loading in the Gulf of Oman, and we are able to capture that loading, and off they go on their way. And so we are being able to see those barrels, and may just not get in there real time from the satellite imagery.
Matt, it's great to talk to you. Thank you very much. Appreciate your expertise. NVIDIA shares are lower following a new report on AI-related price hikes, but the company's also making a multi-billion-dollar bet. We're going to break it down next. NVIDIA shares lower today on pace for their 7th straight decline, which would be the longest losing streak since September 2022. Investors, of course, are looking ahead to Wednesday's second quarter report, where earnings are expected to grow 100% year over year. Today, the company announced full production of its Grok 3 chip. Christina Partsinevelos joins us now. What are you watching on the NVIDIA front?
Okay, let's start with the Grok part because most people don't even know, like the language is just confusing. And NVIDIA is actually putting its Grok 3 LPX into full production. What that means is it's just a piece that slots into its racks with the GPUs, with the CPUs to make AI respond so much faster, especially with open weight models, the kind that anyone can download and customize freely. And that speed lane has been the territory of Cerebras, another chip company that just went public this year. They built their chip around fast inference. The stock has been under pressure for weeks. You can see it's down about 4% today as well. NVIDIA down only 2%, but Cerebras getting hit harder. NVIDIA in general is also making the same bet on the software side. So days ago, it agreed to pay $6 billion to license Poolside's technology, hire more than 100 engineers to build a powerful open weight model of its own. And this is according to the Wall Street Journal. NVIDIA hasn't confirmed it yet. But the goal, why open weight if they're focusing on hardware and their CUDA software? An American open model would rival China's open models, which are dominating right now. Cheaper, faster OpenAI means more usage. More usage means, of course, more demand for NVIDIA chips. So that's literally them attacking the entire stack. NVIDIA doesn't necessarily need to make money on that top layer or profit from that, but it profits on everything that runs underneath them.
Okay, what about these reports that NVIDIA is going to go to its best and biggest customers and raise prices? What's that do to the bottom line?
Well, it helps gross margins. And so the reason they're doing that is this giant concern that the gross margins would dip below 75%, which is still absolutely incredible for a company. Right. If you look at just like FactSet for the Q3, so right now we're reporting for Q2, for Q3, expecting it to be around 74.8%. That's coming down. So here's an opportunity. NVIDIA is getting ahead of the curve. They're reportedly going to raise prices for their Blackwell Rubin systems anywhere between 15 and 17%. And I mentioned the gross, that's really important for this earnings report. You mentioned the 100% growth. And it's like nobody shrugs their shoulders anymore. Like, oh, who cares? Everybody's expecting this already. So that's why they're focusing on other smaller details like the circular financing, gross margins.
And the price part of it, they're not, it's not like the big customers have anywhere else to go, right? That's not, I mean, you got them over a barrel. Okay, I should be recovering. Why am I not?
Is that a question or a statement?
You should be covering chips.
I cover chips, Lay's, Ruffles.
Oh no, come on, that joke is so old. But for the audience that's listening, again, for earnings, we want to focus on gross margins. We want to focus on any type of circular financing stuff, and then the ramp of the Rubin platform, which was in the second half of this year. So this is the latest and greatest.
Isn't DeepThink and Kimi 3 going to kill all this stuff anyway?
Well, that's the reason why NVIDIA is getting in the open weight world with their Neutron.
Margins
and
down, they're raising prices, but margins may get compressed.
Well, it won't get compressed at this point, right? Going from 75 to 74.8%, they've promised roughly mid-70s for a while. The concern is if it does go to 73, you'll definitely see a sell-off in the stock, or even 74%. But that's why they're doing all of
What's the key thing Wednesday night? I'll be hosting Fast Money on Wednesday night.
Well, then you and I will be sitting across from each other.
I know. I'm trying to get ahead of it because I got to wrangle the other crew, too.
Yeah, I'll make sure to bring some
Guy Dami's going to be there.
Yeah.
Tim. Got to wear body armor.
Big sigh.
Yes.
What? And what?
And we digress.
Chainmail.
Okay.
Here we go. Christina, I'm just kidding. You do cover NVIDIA very, very well. I just,
I'm just glad I'm not the only one in trouble at this point. All right, Christina. You're now over to Kate Rooney with a CNBC News update. Kate.
Hey, Brian. Well, we'll start with Congo's Ebola outbreak now. It's recorded one of its deadliest weeks yet, with 317 deaths in just 7 days. Government data does show over 5,500 cases right now, over 2,600 deaths overall as that virus spreads at unprecedented speed. Health workers face rebel threats. They've got bad roads and unpaid staff. More than 16,000 vaccine doses have arrived through their effectiveness against this rare strain remains uncertain. Meanwhile, thousands remain without power in Gary, Indiana. It's nearly 2 weeks after a powerful storm tore through that region. More than 10,000 outages were reported as of Monday morning. Mayor Eddie Melton called the delay unacceptable, saying 12 days is too long for families and businesses to wait. Utility NIPSCO says it's now working to restore service by the end of Tuesday. And finally, Prince Harry is leaving the board of conservation nonprofit African Parks after a decade of service. The group calls the move part of a governance refresh effective September 30th. His departure does come 4 months after an indigenous rights group urged him to resign over alleged abuses by park rangers. Contessa,
all right, Kate, thanks for the news. Appreciate that. Up next, the data center backlash goes national. What does it mean for REITs? Next. As more and more states launch AI data center moratoriums, tech investors are grappling with growing backlash across the country. What impact does that have on the real estate sector? Joining us now on set to give us her take is Ji Zhang, Global Real Estate Portfolio Manager at Cohen & Steers. It's great to have you, Ji. Okay, let's take Texas, for instance. You've got leaders, even at the local level, that are looking at permitting and the regulations that are necessary to build anything, and they're just dragging their feet. So is this the new headwind that investors have to build into any investment in data centers?
That's exactly right, Contessa. The reality is when we look at the data center demand, and we just spent some time talking about NVIDIA and revenues growing 100%, we know the demand is there. But when you look at the data center development and the AI build out, especially when you look at the market that already have moratoriums today and are talking about moratoriums, that is a real risk to data center development, whether it's the timeline or just the ability to whether or not they can even get power. So when we look at our portfolios and our investments, we are very much focused on portfolios and companies that are operating in those specific markets, primary market that have demand drivers, very sustainable demand drivers, and by the way, contractual power. And that's really important. Having that visibility to power becomes even more valuable today.
The CSRE, your real estate active ETF, is up 13% or so year to date. You own, it has Digital Realty Trust, Equinix, GDS Holdings in China. What haircut should you attribute now to these holdings because of the backlash that's happening across the country?
That's a great question. And the way we think about the haircut and the way we think about risk is how certain is that power allocation. So the good thing is when we look at our investments in the listed REIT universe, the Digital Realty, the Equinix of the world, they actually have the majority of their pipeline that has contractual power. But if you look at some of the private players out there that have massive development pipelines in Texas and in some of these markets that are really front and center, when you think about the moratoriums, that haircut and that timeline and the ability to even get it done is real. And I think that is going to be a real.
But you're tying it still to power availability, not political permission.
I think in a way they are hand in hand. I do think that when there is contractual power with the utility companies, the probability of that getting done is significantly higher. But with that said, we are monitoring the permitting, the local jurisdiction, and whether or not they have the ability to get that done. And there are certain times and scenarios where things could get tied up in court.
Yeah.
There could be scenarios where timelines get much more prolonged. So I do think that is a risk, but the bigger the development pipeline, the bigger the risk.
We haven't seen any huge data centers get canceled yet. I assume if that were to happen, you might change your tune. There are some pretty big shorts. Jim Chanos, negative on Equinix and Digital Realty, doesn't like the balance sheet. Forget about the political stuff. You're obviously not worried about their balance sheet. How come?
Well, what I would say is there's a big bifurcation between the balance sheets for the companies in the listed market versus some of the private developers out there. So if you look at Equinix, for example, their net debt to EBITDA is just over 3 times. Digital Realty is just over 5 times. So that is very healthy relative to what we're seeing out there. With that said, right now, the financing availability is still there. Developers are still able to take pretty high loan to cost at pretty attractive interest rates. But if you think about everything that's going on in the market today with concerns about sort of just credit overall within the AI ecosystem, those private, highly levered players is where the risk is.
Ji, thank you so much for coming into the studio. Appreciate that. Ji Zhang is with Cohen & Steers Global Real Estate Portfolio. All right, coming up, travel stocks are taking off. We're going to show you some of the big winners. That's next.
Well, we got the graph.
Welcome back, everybody. 3 travel stocks have soared over the last 6 months. Airbnb shot up roughly 50%. Expedia, more than 60%. Timeshare company Marriott Vacations has doubled in 6 months. All 3 companies are using technology to get more out of eager travelers. Now, Airbnb is applying AI across the business, from search and listing to customer service. Its AI assistant now resolves nearly 45% of issues without a human, helping cut support costs per booking 16%. Their revenue grew 17% last quarter. Expedia, meanwhile, revenue up 14%. It's pushing AI across its business too. Trip planning, booking, service. It just bought AI trip planner Layla, while its fast-growing B2B business saw revenue jump 23% in the second quarter. And then you've got Marriott Vacations, focusing on personalization with a new data-driven system that matches timeshare customers most likely to buy with the salesperson most likely to close them. You know those presentations where they're like, you should buy this timeshare. Well, the company says it's doing roughly the same number of sales presentations, but significantly higher rates of success. Plus, they've got these new loyalty tiers that are encouraging existing owners to upgrade. And they saw that owner sales actually surged 41% in the most recent quarter. Look at the results here. Not necessarily more travelers for these companies, but smarter ways to turn travel intent into more revenue. Now, here's the interesting...
What does that mean? They're using AI to match up salespeople.
Yeah.
So, like, let's say you got somebody who's a potential buyer who's from
for them, it's
Michigan,
not
right?
even
from
AI.
Upper Michigan, and so you put them with a salesperson from the UP, and they're like, oh, yeah, you want to buy up there.
It could just be an old-fashioned algorithm that matches buyers and the salespeople. But listen, Airbnb says we know that if we can capture more of your information about what you like and where you book and who you're booking with, we can